It's logical. And one thing the past 3 years has done is inject such incredible humility for all of us in the unplanned and the unseen events that come and torpedo all of the nicely planned theories. As we sit out here with the growing uncertainty of what the resolution will be with Ukraine and the ongoing turmoil within Russia, how will that potentially shake your current estimation of what's going to happen?
Well, Lisa, what we learned this weekend is we don't have a clue about what can happen next in Russia or Ukraine, for that matter. So that's, that we can only speculate. I can invent a dozen scenarios for you, but none of them has more than about a 1 or 2% probability. So we just have to admit that we don't know how Ukraine's going to work out and how that's going to affect the world. I mean, consider the possible ramifications of what could have happened this weekend, right? Political disarray in the Soviet Union, taking the third largest producer of crude oil in the world off the market, taking a large dominant producer in major commodities off the market. These are events that just on the economic side, could shake up the world economy substantially. We could see a surge in commodity prices. I can make up scenarios like that, but I can't have any confidence in them.
Carl, I've got to spend some time on China here. Your China note, I actually read it the other day, every word of it. Just the trend here out of China, what is the misreporting or misanalysis we should focus on with China right now?
Well, Tom, I think that that China believes at the senior level, all right, they don't want to make total nice with the United States right now, but they do see more benefit to a peaceful coexistence than to a new Cold War or increased competition. And I think the way that they received Secretary Blinken was very indicative of their intentions, and a lot of good stuff came out of that. We did have the slip of the tongue by President Biden, which set things back a little bit. But if you read the op-ed in the People's Daily, they just breezed over that and got right back to the juicy stuff about how Blinken's visit opens the door for exchanges between the two countries and how that can only be good. So I'm hoping for a little bit of détente, if you will, in the battle between the two economies. I can't promise that any U.S. administration from either party is going to be more friendly to China, but I think that we're going to see the Chinese try to de-escalate things a notch or two so that the world can get back to business. They need to have growth through trade. And their trade with the United States has actually declined. Gross exports plus imports has actually been coming down. And they probably miss those exports. And as growth starts to fall short of their desired trajectory, they're going to want to do more and more of it.
Carl, we got to cut you short. You've been way too optimistic. Lisa and I are just used to this. Carl Weinberg, legendary high-frequency economics. I have never heard Dr. Weinberg that optimistic.
He said the last time was in the 1960s.
I have never heard it. He has been so right about some of the shocks internationally, and particularly 07, 08, 09, and all that. And I think we've got to stop here and just suggest that, boy, is there a tension out there between people cautious on the markets and people like Carl Weinberg saying, I'm sorry, this is going to work out. Well, we're going to move on to some form of prosperity.
If you look at the details, if you look at a full labor market, aside from concerns that this might prompt central bankers to be more hawkish, that's a good thing, isn't it? Don't we want people to have jobs and to be getting wage increases and be able to have, consumer spending and be able to pay down debts that aren't as big as they used to be? This is a good thing, right? And this is what he's talking about.
I believe so. I mean, did you have any Fed speakers in your brief this morning? I guess we were sort of Russia-centric, so.
There are Fed speakers later in the week, and really it is going to be focused on what happens with Wednesday, given the fact that we are going to see ECB President Christine Lagarde. We're going to hear from Jay Powell. We're going to hear from Andrew Bailey. We're also going to hear from the new central banker, Ueda, of the Bank of Japan, all of them on the stage together at a time when they're kind of starting to splinter a little bit about the need to either double down or perhaps take a big beat back.
The dollar yen 143.04 is certainly buttressed up there. Maybe not a big deal, but anything weaker through 146 would be a huge deal. The euro, of course, that's all that's going on, stable. 109.05. And Lisa, I think we can say, as we call Tina Fordham, I think, really colored it well, given these immense tensions that are out there. The markets have been pretty stable, ruble weaker, but you'd expect that.
This is really, to me, the biggest question, why there hasn't been more action. The fact that there hasn't means that no one in markets want to make any conclusion whatsoever, which turns to this question: do you go to what you don't know and game out the probabilities of different scenarios, or do you look at what you do know? This is sort of the Carl Weinberg point, and what you do know is that things look pretty good, and it could be the first time in a long time that policymakers are able to achieve a goal with disinflation. Actually, what he thinks is taking inflation back to that 2% target, possibly even within the next year or so.
Yeah, we'll have to see. Let's bring it back to the story in Russia and the latest headlines that you have. Bloomberg leading with our team. Putin faces historic threat to absolute grip on power. It's sort of, I can't gauge out what not absolute grip looks like, but, you know, I get the point from Bloomberg.
The perversity of this all. On one hand, there was a cheer with Prigozhin possibly marching on Moscow. Yeah. And you saw the videos of Ukrainian leaders eating popcorn and watching this. They were pretty excited about it. But Prigozhin's no saint himself. I mean, he's been pretty brutal in terms of some of the areas he's taken over. There's a question, which is worse, right? Who do we want to be a leader? And if you don't have a leader at the helm of a major nuclear power, that's also concern with nuclear proliferation and a whole host of other things. These are some of the issues that some of the key intelligence agents of the U.S. are watching right now.
The Telegraph comes over, or the FT is saying Prigozhin still under investigation for mutiny. That, to me, is the sort of the Monday morning headline. We don't know, but there it is, still under investigation.
And this is my shocked face. I mean, how could he get off without anything? What does that mean for Putin? And the back and forth doesn't really speak well either.
We will not speculate. We'll do what Bloomberg Surveillance does. We will speak to experts. In the 8 o'clock hour, Ian Bremmer will join us from Eurasia Group. He was fabulous over the weekend with perspective on these historic events in Russia. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I believe that the short term is an issue in Europe and in the US because we have to work our way through the inflation problem without causing a deep recession. But in the medium term, if you think 2 years ahead, there's nothing but good news. We've seen the major technological innovation that is going to increase productivity, and I would expect that if we were sitting here again 3 years from now, everything would look an awfully lot better than it is today.
He is David Folkerts-Landau. To say he's chief economist at Deutsche Bank barely describes his academic research, particularly on flows of capital, particularly this interesting relationship between China and the West. And we see it this morning in dollar renminbi, the yuan plunging out 2.6 standard deviations. edge of plunging, maybe is how I would put it. 7.23 on yuan. It went through 7. That was a big deal. 7.15 was a target for many. And I don't know how you reassess here at 7.23. At least another indicator there of global slowdown besides a weakness in China is Brent crude 74.23, fractionally higher. West Texas Intermediate still can't get above 70, which frankly surprises me. 69.44.
To me, the stasis that you just sort of laid out, the confusing churn, highlights just how many push-pull factors there are right now. On one hand, China's slowing economy, sending its currency lower, even after it tried to set the peg at a stronger than expected level. And then on the flip side, this question around oil. What are the consequences of a conflict that continues to percolate in the region, in Russia, in Ukraine, at a time when Russia is still shipping a lot of barrels of oil onto the field?
And just one of the strands of speculation not reporting is, as you mentioned earlier, the heritage of Wagner in Africa, in Syria, in places. Do they remain, and in what way do they remain in Ukraine? I mean, it's not a conversation for now, but that's got to be a huge uncertainty, or at least unknown, I should say.
When I was reading all the notes over the weekend, every single one of them keyed in on commodities, whether it was natural gas or whether it was crude or whether it was wheat. And one person who does track all of it out of the realm of speculation into fact is Will Kennedy of Bloomberg News, who joins us now, Senior Executive Editor for Energy and Commodities. Will, what are you watching after the events of the weekend and the turmoil and questions around what this means for commodity prices?
Well, if we take oil, obviously turmoil in the heart of the Russian state is something the oil market needs to be aware of. Russia produces more than 10 million barrels a day, 1 in 10 barrels globally, and it exports 80% of that. But one of the important facts, I think, since Russia invaded Ukraine is after a blip in the immediate aftermath, that oil has continued to find its way into global markets. Russia is getting its barrels to global markets. It needs the money to finance its war effort. And as long as the state remains coherent, there's every reason to think that Russia will continue to see those barrels flow. And I think that's why, despite the clearly heightened geopolitical risk around Russia after this weekend's events, the oil market has taken it in its stride. Because as you said at the beginning, Lisa, there is plenty of oil supply globally. That's one of the factors feeding into today's market. And in the short term, at least, there's no reason to think that that's going to change.
We've had some time since the war started, unfortunately. It's been more than a year, and there's been a big discussion around resilience and energy independence. How much progress has been made on that level and potentially removing some of the geopolitical risk in this sphere when it comes to particularly oil prices?
That's right. I mean, there was a huge concern that the flow would stop and that would hit those countries in Europe, especially that were very reliant on Russian hydrocarbons. But the oil market has pursued, and the wider energy market has proved itself to be incredibly flexible, incredibly resilient, partly because of the way that policy has been constructed to try and limit the price that Russia gets rather than the flow of barrels. Those barrels have been redirected to India, and that's actually happened remarkably quickly and remarkably effectively.
Right. Will, an unfair question, but you're so briefed on this, I'm just going to take advantage of your encyclopedic knowledge. I believe we found over the weekend a huge amount of cash from the Wagner Group, which I assume was paid for by Russian oil. I mean, the amount of cash shown, folks, was almost as large as the advance Javier Blas got for his wonderful book, The World for Sale, the movie rights for that. But seriously, it's like millions and millions of dollars of cash. Did that come from barrels of Russian oil, Will?
I have no idea, Tom. I have no idea. I mean, but one thing that we do know about Wagner, which you mentioned earlier, is that it does have a role overseas. And I think one country that people are very interested in right now is Libya, where Wagner plays a big role and has been a factor in the oil industry, keeping oil out of that country. That's been very volatile, oil exports from Libya. And that, I think, as we track the fallout from these momentous events, that's another country we might want to keep half an eye on.
How does Turkey play into this? I mean, clearly Turkey's not an oil power. Maybe it's not off your radar, but I saw Lira print 26 today. Erdogan making comments as well. As a commodity nexus, where does Turkey fit in at the Bosphorus Strait?
Well, the Black Sea is incredibly important here. Obviously, a lot of the events that we saw over the weekend unfolded in the southern Russia, Rostov, and that is at the heart of the wheat industry, the agriculture industry in Russia in particular. Grains out of the Black Sea is very important. Clearly, Turkey has been very important in brokering the continued flow of grains from Ukraine. And a lot of Russian oil comes out of the Black Sea. So while things remain calm, it is an area of focus if we were to see more chaos in Russia in the future. That Black Sea area, where obviously Turkey is a central player, as you say, Tom, is incredibly important both for the flow of grains and oil out of the Russian Federation.
It's interesting to ask about the resilience and what's been transpiring over the past couple of years to offset any potential interruption. And I want to go back to that point because there was this AAA survey put out overnight talking about how we've seen this in the U.S., that even though we're going to see a record amount of demand for travel that is used to be fossil fuel intensive, it's going to be less consumption of gasoline than in the past. Do we have a sense of how much electric vehicles and other types of renewable energies will offset, again, any kind of potential influence from what's going on in the turmoil?
It's a very, very interesting question. I don't think we know all the answers yet, Lisa, and it is at the margins. I would say in the US, EVs have a much lower penetration than some other parts of the world, Europe and especially China. But one trend that we do see in the US is that, on the whole, many vehicles are becoming a little bit more fuel efficient. So the amount of gasoline you need for each average mile has tended to trend gently downwards, and that's feeding through to the AAA estimates that you see. I think in China, where we're seeing really quite a lot of penetration of electric vehicles, there's a very interesting discussion about how a resumption of economic growth in China, which is obviously weaker than people would like, how energy-intensive economic growth is, and how, as the economy grows, as people drive more, how much that truly feeds through into oil demand. And I think there are some indications that that equation is starting to alter because of the EV penetration in Asia.
Terrific brief. Will Kennedy, thank you so much. Will Kennedy, our executive editor, driving all of our hydrocarbon coverage here with West Texas Intermediate, 69.48, Brent crude 74.26. I want to go over the bond market right now with Lisa. We're a bit off our radar this morning with all the news that we're seeing from Russia and speculation, I should point out, as well. And to me, the telling thing, Lisa, is I've got further curve inversion out to negative 102, as Liz Ann Saunders just mentioned on Twitter, not out to the March maximum inversion that we've seen, but boy, are we getting there quickly. But at the same time, the 10-year real yield has come in, and that's something new. We went from a 1.54 into a 10-year tip 1.47, and it's new now to see further inversion with a lesser inflation metric.
People are gaming out a real slowdown. How much is this on the heels of what we saw over in Germany, right? The business outlook deteriorated to the lowest seen in a year. We saw that with the IFO Institute gauge falling significantly in the month of June. Is this coloring people's view that perhaps we are going to see in the data an ongoing slowdown, and that's reflected in the yield curve becoming more inverted, and also a lesser real yield? That said, are we just flipping and flopping from the euphoria of the first 6 months? Now people are kind of retracing a little bit.
I don't know. I've got some euphoria out there. I mean, Carl Weinberg's killing me with his optimism. I think we've heard it from some other people as well. I'm fascinated to see what Michael Darda says. I would point out the Bloomberg Total Return Index. This is aggregating in a U.S. total return. It's one of about 8 indexes that we have. It's in an indeterminate pennant formation right now. I really don't have a break of price up, yield down, or price down, yield up. Within the noise of your world, I don't have a break yet.
So an indeterminate pennant formation. It sounds like something that you'd find at Tiffany's.
You sit with a book on your lap. Yeah, it is actually.
Pendant
you sit
formation.
With it's a pendant. It's Schlumberger. Let's not go there. It's like you sit with you look at chart formations. You know, it's like white smoke coming out of the
astrology.
Tower. It's like astrology. Better said. Futures -6. Mark Anderson, UBS Global Wealth, coming up. Bloomberg Surveillance. Good morning.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
In a
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
Both consumers and companies have been more resilient than really the consensus expected.
That wall of money is out there spending, and particularly on services.
We think that these recession headwinds are going to catch up with us.
The bigger risk is that the Fed loses its resolve in the face of this weakness and allows inflation to become entrenched.
We're probably at one of those precipices right now where we're peaking in optimism.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. John Farrow on assignment here on a Monday, and truly an historic Monday for all within international relations after the shock of a weekend. To bring you up to date would take 30 minutes. We've got 30 seconds right now. And the uncertainties this morning, Lisa, on Russia seem to center around where are the people, and are allegations and speculations over the weekend still in play? We don't know.
And how do you play the crosswinds that leave us in sort of a push-pull, perhaps stagnant, in the same place of uncertainty? Do you look at the now, as Carl Weinberg was saying, which leaves him the most optimistic since the 1960, or do you look at the potential iterations of how this transpires? Just to give you a state of play, if you're just joining us right now, we are hearing that Prigozhin, who does head the Wagner Group, may or may not have immunity in Belarus after attempting to march on Moscow. What this means, we just don't know, Tom.
Well, we don't know, and it's as simple as that. We're going to keep briefed here with experts here on the international relations, the complexities of it as well, and also what Bloomberg News is reporting. The basic idea here of mutiny, not coup, which is, I agree with everyone, is just the absolute wrong word to use. Maybe it's what we use in the fervor of Saturday. But on what I guess is a mutiny or an insurrection, is this gentleman from Wagner still under investigation? To me, that's the one kernel we can grab onto this morning.
Here's what we don't know. Maybe that's going to be helpful to give you a sense. We don't know what his motivation was when he marched on Moscow, which is a reason why you can't say a coup. A mutiny, perhaps, because he was questioning Vladimir Putin's authority. He has been a vocal opponent of some of the tactics that Vladimir Putin has used, as well as the rationale for the war in Ukraine. He hasn't been prosecuted, perhaps because Putin needed him. And now what? And how is Vladimir Putin trying to navigate his allies that are concerned about a weakening power?
I mean, we're going to have to see here. And part of it is we're doing this wrapped around economic slowdown. We see the slowdown continue this morning. I mean, Lisa, the 10-year yield in 5 solid basis points. Remember, we were on the 4% watch, sort of, kind of like, I'm exaggerating, 3.68%.
People are gaming out what it means. First of all, we did get that data that was disappointing with respect to sentiment in Germany. We are expecting to get ongoing signs of the manufacturing recession in the U.S. Things are slowing down. How do you game that out with hawkish rhetoric that we heard last week from central bankers with Sintra and then very much at forefront?
This is Wednesday's a big day?
Wednesday's a big day where you get the ECB President Christine Lagarde, Jay Powell of the Federal Reserve, as well as Andrew Bailey of the Bank of England.
Is Sintra pre-Jackson Hole? Or is Jackson Hole post-Sintra? This is a philosophical question.
Deep thoughts by Tom. If we don't do Fed speak, we'll just do, wither big central banking hobnobbing. Honestly, these are the seminal speeches. And how different is it now versus late August, after the data that we get? And that's when we get Jackson Hole.
My observation is Francine Lacroix is going to get a lot better food at Sintra than chip beef on toast in the Pioneer Grill at Jackson Hole. Let me get through the data check here before Lisa's brief. It's real simple. Bitcoin's done nothing for us. We have to have the Bitcoin quote for Katie Greifeld. Futures -8, Dow futures -25. As we mentioned, yields are in. 2-year yield in 4 basis points. Even the 30-year in here on global slowdown. Curve inversion, -102 basis points is stark. Oil under 70 on West Texas Intermediate, 69.29. And currencies a jumble. Yes, ruble weaker back, I believe, 15 months as expected. But others, I'm going to call it Euro resilience, 109.05.
People gaming out the unknowns and saying we can't really settle with the unknowns and we'll stick with the knowns. This morning we'll deal with the knowns and we'll deal with the facts and the real knowledge of a host of wonderful guests, including retired Lieutenant General David Tula, currently a member of the board at Academy Securities. That's going to be at 7:45. 8:15 a.m. Ian Bremmer of the Eurasia Group. Later on Bloomberg TV, we've got Lieutenant General Ben Hodges as well as Alina Polyakova from the Center for European Policy Analysis, who all will be very much well-versed and better versed on this than us. 10:30 a.m., the latest with respect to the manufacturing recession. U.S. Dallas Fed manufacturing activity comes out, which could be important because it has been indicating recession despite all of the resilience that even Carl Weinberg was saying is leaving him the most optimistic since the 1960s. And at 1:30 p.m., kicking off the Sintra Jackson Hole preview, or perhaps the Sintra taking this team out of Jackson Hole. ECB President Christine Lagarde giving opening remarks at the ECB Forum on Central Banking, opening reception and dinner over there in Portugal, Tom.
We've got lots coming up here. Maria today on Brussels, Anne-Marie Horton in Washington will be with us in about 10 minutes. Right now, we'll consider what to do forward, less away from international relations, and much more about your portfolio. Mark Anderson joins co-head of Global Asset Allocation, UBS Global Wealth Management. Mark, I thought your note was exceptionally interesting of looking for a lower rate of return on equity. And what I find interesting is a search for durable income. Describe what durable income is.
So first and foremost, I think we find ourselves a bit in a camp where we think that economic activity is likely to slow into the second half of the year. So a bit like you mentioned before, we have yields on both treasuries, sort of the safer haven investments out there. They're coming down, meaning the prices are going up. But we cannot be too safely only in our portfolio. So we're looking for durable income in equity markets that are trading a bit more attractive than U.S. markets, where we have an attractive dividend yield. We are looking for yield in emerging market currencies as well as issued in U.S. dollars, where we find that current yields of around 8-9% is something which is very attractive to add to a portfolio at this point in time.
I look at the portfolio and it seems like you're distant from 60-40. What is your equity allocation?
In a balanced portfolio, we are slightly below 50%. And I think we find that the value of diversification has certainly gone up quite tremendously. And I think with the latest developments in Russia, it's a grave reminder that geopolitical risk is there. We have to think about diversification, both in risk scenarios, but I think equally in a world where inflation might be staying sticky. It's something that will be a theme continuously, obviously, but I think with the risk for commodity prices to move upwards on one hand side, for central banks might to preliminarily having paused, at least in the US, we need to find some of these diversification in the portfolio, which can come through oil, gold. We're thinking about hedge funds as well. So we do have something that's quite different from the traditional 60-40 portfolio, Tom.
Diversification has a very unclear meaning at a time of odd correlations. Are big tech stocks in the United States acting as an equal kind of hedge against geopolitical risk as treasuries? Is that a safe haven for you? Or are you looking at equities being inversely correlated to bonds once again, the way that they used to be?
So first of all, on AI, so I think the way we like to think about diversification is something that first and foremost we can see in correlations through historical analysis, but equally through our scenario analysis as well. And I think the one concern we would have around something like AI, which is certainly a great long-term diversifier, we have many of our so-called long-term investment themes that are tilted towards AI developments. However, in the shorter term, we're looking for diversification of something that works well both in our base case and more of a risk scenario as well, where not only would inflation stay sticky, but we might get a bit more of a deep recession, which is something that people are questioning at the moment. And here's something like a yen that you have debated earlier is a safe haven currency that's very attractively valued, very oppositely to something like some of the AI-related stocks, which might be a diversifier for the very long term. I would only agree, Lisa, but in many ways is very, very expensively valued, at least on most of our metric, and therefore in a downturn we'd expect to be selling off as well.
How have you shifted allocations and shifted your views as we head to the second half of a year that has defied all expectations?
So I'd say the one thing that has certainly defied some of our expectation is that the global economy has held up a lot better in this first half of the year. Inflation has as well. As you noted just before, we're starting to see not only manufacturing PMIs, but some of the service ones as well. Let's not forget that ISM non-manufacturing came in at around 50 last month. We're going to get the latest reading out very, very shortly. And I think we're likely to get a confirmation that the economy will be slowing. So those are some of the signs that we take into account when we're trying to construct our portfolios, where we've become a little bit less optimistic on equities and US in particular, more centered towards fixed income investment at this stage.
Mark, help me with your commodity call, and particularly on oil. The $100 barrel crude is in retreat. Where is UBS?
So we're thinking that end of the year we could get Brent around $90 a barrel. And I think it plays into, there's a lot of interesting dilemmas here going on, because on one hand side, you would say a slowing slowing global economy would tend to suggest that demand for oil would be going down. On the other hand side, we see a very, very rapid supply response from OPEC whenever prices are falling down. I think that's adding a little bit of a cap. Then on top of it, we have very limited risk premium in the market at the moment around Russia. We know that strategic reserves are very low at this point in time, so we suggest that any fall in oil prices would lead to a bit more of a buildup of some of these inventories. Implied volatility is very high, so one thing that we're doing for our global investors is buying put options on oil, so basically selling volatility as a way of generating income. And it goes a bit to the durable income point that you mentioned here before as well, Tom.
Mark Anderson, thank you so much. Greatly appreciate it this morning with UBS. Literally, there was one point last week, Lisa, where all this allocations talk and bull bear, bad news, you know, you and John make the joke about good, bad news or whatever you say. There was a point last week, folks, I'm not kidding, my head was spinning. I mean, it was literally, I rarely say that, and there I was with my head spinning.
You're not alone. I think a lot of people feel that way. There's just an utter confusion. If you think about just what even transpired over the weekend, the potential tail risks could be either positive for commodities or negative commodities. The potential tail risks could be incredibly positive for risk assets or highly negative. And so that's the reason why perhaps this churn that you're seeing in markets represents the spinningness of everybody's heads.
The spinning of it, to me, goes back to oil and the great uncall. Good morning, Edward Morse, Citigroup, for just being way out front on the geopolitics of a lesser demand. 69.44 on West Texas, Brent crude 74.20. 1922 this morning. I should point out gold up $12 now this morning, 1942 on gold. In the equity market, NASDAQ down a little bit more. The VIX goes out a stick, 14.49. And the Standard & Poor's 500 is down 0.2%.
The quiet and the confusion, the head spinningness of markets has left a question around the leadership and honestly the employment at a number of big banks. This just coming out from Sridhar Nadarajan and Catherine Doherty. That Goldman Sachs is planning to add Tom Montag, formerly of Bank of America, to their board, Tom. A really interesting move at a time when they're cutting managing directors and facing a lot of turmoil.
This is a really, really interesting New York story for those of you worldwide, and I don't think it is incorrect to say in the complete, total chaos of the mating of Merrill and Bank of America, Montag from Goldman Sachs showing up 3 cups of coffee before the financial crisis, and what Ken Lewis wrought. This was Moynihan's guy. I think it's not off the mark to say this guy single-handedly saved the bank, with great respect to Brian Moynihan.
Is this David Solomon trying to shore up his leadership at Goldman Sachs?
Absolutely. Absolutely. This is a huge deal. I'm not expert in the cultural nuances here of the ex-Goldman partner going back to the mothership, given all that's been written about in the last 3 or 4 days on Goldman Sachs, but I wouldn't underplay this. For those of you globally, in New York, Montag back to Goldman Sachs is a huge deal.
And I love what you flagged earlier this morning, Montag known for keeping a spreadsheet during the pandemic of people who worked from home and people who were in the office.
Can I say, Brad Qantas, can I say he's a hard ass? Can you say that on radio?
I think you just did, darling.
I don't know.
Yes, well, that seems like
he's
definitely.
He is old school.
Sri
Nadarajan will have a lot on that. Please stay with us. Futures negative. Oh, I'm in the, someone from Sparta emailing in. I am in the timeout chair. Futures in -6, Dow futures -16. We will consider Russia in moments. This is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This really does hurt Putin, and not only just politically and in his leadership in Russia and his presidency, but in his efforts to continue the war in Ukraine. Putin himself went on national TV to respond to Prigozhin, and Prigozhin said that your government has lied to you. This is not a war that NATO started. There are no Nazis in Ukraine. Taking down the very premise makes it much more difficult for Putin to continue to turn to the Russian people and say we should continue to send people to die in this war for which Prigozhin himself has said to the Russian people the premise is a lie.
Mike Turner, he was with CBS's Face the Nation there. Margaret Brennan here, the chair of the House Intelligence Committee, House Intelligence Committee. He's the former mayor of Dayton, Ohio, among other things, commenting there on the moment. What's interesting, Lisa, is Sunday morning, let's call it 10 a.m. on Face the Nation, seems ages ago. You know, to be fair to Chairman Turner, things have changed.
Things have changed, and the uncertainties have only grown. Perhaps time has gone on, and maybe there are more details that we're aware of, and yet that only raises more questions about what exactly the nature of Prigozhin's march to Moscow was, how much this weakens Vladimir Putin's power, who potentially is advising who is backing who, what the potential ramifications are in terms of the war in Ukraine. All of these are not necessarily resolved in any way, shape, or form, at least in the public eye.
Right now, we're going to canvass from Washington to London to Brussels. Anne-Marie Horton with us, our Bloomberg Washington correspondent. And tirelessly over the weekend, Maria Tadeo in Brussels has tried to coalesce all the different tones. Maria, I haven't asked this yet. If this guy goes to Belarus, what will the greeting be like north of Ukraine?
And it's a very good question because we don't know the terms of that deal that Alexander Lukashenko, who, remember, he is the president of Belarus, although the international community says he rigged the election and they do not consider him the actual president of Belarus, but he is very closely connected to Vladimir Putin. The only reason why Lukashenko is still in power is because Vladimir Putin supported him in 2020. So I presume that Lukashenko will treat Prigozhin in the way that Vladimir Putin asks him to.
So within all your reporting, the linkage of Moscow and Belarus is still intact. Putin and Lukashenko is still a relationship. It's one of the foundational things we can believe in this uncertainty.
Are they friends? No. Do they trust each other? Probably not. Do they need each other? Yes. Is this a transactional relationship? Absolutely yes. But for the time being, it works for both. And now we're also seeing that Russia has decided to send the tactical nuclear weapons to Belarus. But again, the question is the terms of this deal that allegedly Lukashenko cut. What are they? And now we see today, this morning, that the Russians are seeing not so fast this idea that Prigozhin has amnesty. It's actually not correct. The investigation continues. So you could argue even the life of Prigozhin is not clear that he will either make it to Belarus and that he will be treated well there.
Anne-Marie, from the U.S. perspective, do they like Prigozhin? Do they think that it was good for him to gain power? Or are they watching this with trepidation on both sides? Perhaps this makes it better for Ukraine or makes the odds better for Ukraine winning if it does weaken Vladimir Putin. But are they about to align themselves with Prigozhin?
Well, I think what you heard from Secretary of State Antony Blinken, his remarks over the weekend, one of them was that there are just still so many unknowns and a lot of questions, and this is not the end of the story. To Maria's point, we don't know the details of this deal that Putin struck with Prigozhin, and we don't really know exactly how this is going to end. Remember, the investigation into Yevgeny Prigozhin is still ongoing in Moscow, even though he was allowed to leave to go to Belarus. Yevgeny Prigozhin is not an individual that is liked by the United States of America. This is a warlord. This is an ex-convict. This is someone who has bloodshed on his hands from Africa to Syria to Ukraine throughout the years. Someone quipped to me that this is Putin's Frankenstein. This is a monster that he created that then it got out of hand. Many do not think that Yevgeny Prigozhin was trying to orchestrate a coup. This was mutiny, and he has been ignored for weeks, for months, by Vladimir Putin, and he was trying to really get his point across because he felt like he was not getting the support adequately needed for the Wagner troops from the Russian military.
Anne-Marie, we have a lot of questions. There are a lot of unknowns. Do we have a sense then of how important this is, given that some people are saying this is the biggest revolutionary kind of act going back to 1917, and other people saying we just have no clue what this is. We don't know how to categorize this, and we don't even understand whether this weakens Vladimir Putin significantly.
So there's one individual I really would point to over the weekend in their analysis of what went on internally in Russia, and that was Tatiana Stanoeva. And this is what she said. She had previously voiced that This was a powerful blow that has been dealt to Putin and the state, and this will seriously affect the regime. But she said, I want to point out that the issue of image for Putin has always been secondary. So yes, optically, this is a massive blow for Putin. You had Yevgeny Prigozhin with tanks, with military weaponry, with his troops 2 to 3 hours away from Moscow city center. At the same time, Putin, as we've seen in years in the past, if you've covered him or been in Russia, when there are individuals and cracks, he gets in at the very last minute and he secures it with a deal. That is what he did here. So it shows that he still has massive amounts of power, but obviously there are cracks.
Maria, help us in our ignorance, and there's been some good articles on this in the last 48 hours, of a given ICBM, an intercontinental ballistic missile pointed west somewhere in the in the far Western Russia sphere. I mean, are those missiles like right over the border? And should we be as concerned about them as some people speculate?
Look, Tom, I think when it comes to Russia, that was, again, speculation yesterday about what should we do with the nuclear weapons and how to respond and all of this escalation. Every Eastern European leader that I reached out to and officials in the eastern flank actually said this whole situation is good for Eastern Europe because it means they will get more troops. And in fact, today Germany announced that they're sending more to Lithuania. The Eastern Europeans also say at this point, whenever there are situations like this, Russia likes to bring up the idea of nuclear concerns because it thinks it will scare them. But overall, and I would point to the words of the Polish president, Duda, what they say is that, if anything, this was an embarrassment for Russia and the situation internally has de-escalated. The one thing I would point very quickly, I did speak to a very good contact in Ukraine and I asked, is this good or bad news? And this person told me it is very good news. It shows once again that Russia is not invincible, but also this myth of the KGB men, to some extent, well, it's a myth.
Maria Tadeo, thank you so much. Amory Horton, thank you so much. Amory Horton with Balance of Power tonight, and they'll have an update here and, of course, on the delicate discussion on nuclear weapons. Putin here, this is a quote, I believe, from Reuters, Mr. Putin calling them invincible weapons as part of the fear. I'm uneducated on this, and the answer is I think I got to get more briefed on this, to say the least.
A lot of people were talking over the weekend that geopolitical leaders wouldn't be that concerned about this if it weren't for the nuclear weapon question. And a vacuum of power in Moscow is a real problem, not just because there is a question over who takes the role, but this question over what happens to nuclear weapons, which is only second to the U.S. in terms of its size. That's the big concern in terms of unstable leadership over in Moscow, even if it does benefit Ukraine in the short run.
We'll have to see. The futures here, they're pretty much stasis. Do you agree with me on that, Lisa? I mean, it's just sort of just like, you know, we opened and there's an opening statement here on where the markets are, and I think we're just waiting for more information. I'm talking within the economic sphere. You mentioned Germany. Statistics showed a little bit of weakness, to say the least.
Yeah, the weakness in the IFO sentiment survey going back a year, and there is going to be an ongoing slew of data, including home builder sentiment and some of the home building stats later this week, as well as sentiment on Friday from the United States, from the University of Michigan. I'm listening. Are we still on the theme that hawkish central banks are going to kill the dynamism of the tech trade and some of the other positive economic trades of the first 6 months of the year?
The banner here, Apple. You know, this is under the radar. Friday, near record high, 2.936. I think I got the number of zeros right on radio. There's 36. There's 8 zeros before all the fancy numbers. Coming right up on 3 trillion.
Yeah, Tesla doubled
it's
in its
terrible. We're all going to
valuation.
die. They're going to go out of business. Futures at -6. Amy Wu Silverman, RBC Capital Markets next. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance, Jonathan Farrow, Lisa Bramwitz, and Tom Keene. Mr. Farrow is on a continued assignment. He's like on a third island somewhere. I don't know. It's like
hopefully he's having a good time.
Ischia, and I can't pronounce the third island, but there he is. He's out there. Futures doing a little better than they were an hour ago. Futures -5, Dow futures at -11. Yields are in sprightly. 10-year yield 3.68%. 2-year yield 4.70%. There is curve inversion, -102. And as I mentioned, probably the one distinguishing feature this morning is the inflation indicator, the TIP. The 10-year real yield is 1.48. That was 1.54 before there was mutiny in Russia.
Is that what we're calling it?
Yeah, that's from Stan Freberg, Mutiny, Mutiny, Mutiny. It's an album from my childhood.
We can play it over the reports, the questions that we have.
Rumble, 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 mutiny, mutiny, mutiny. It wasn't a coup. I think a lot of the news organizations have really been good about that, including Bloomberg, of saying this is not a coup. That's what we made up in the heat of Saturday and all that. But it's something much more. We'll have more coverage on Russia here coming up. Our team is working tirelessly. You'll see that through the morning and into the afternoon as well. But right now, I think we need to move with movers. And we start by saying Tom was wrong. So that's a good way to start.
Well, I mean, just to give a sense of what else is going on outside of the drama spurred inside of Russia, there is going to be a stress test result coming out on Wednesday. The Fed is still very focused on the U.S. financial system. PacWest Bancorp very much in the news this morning. This looks like a big pop, 7.3% gain. Tom will roll his eyes at me. The shares are $7.76 off a peak of $51.20 in January 2021. But this comes after they sold a $3.5 billion asset-backed loan portfolio to Ares Management as they try to bolster liquidity with some of the outflows they've been seeing. We'll get a review of that coming up on Wednesday. No surprises in the Friday report that we get every week. But I am very closely watching this because, Tom, you asked the question, is the banking crisis over? Yes, maybe. Who knows? We're still watching, and I think that that's what people have to say.
We'll have to see on that. We've got a chart on that here in a bit. What else do you have?
Alphabet dropping about 2.3%, or Tesla first dropping 2.3% after being downgraded to neutral from buy at Goldman Sachs. This comes after the shares have just skyrocketed so far this year, but an increasing number of analysts are coming out and saying we don't know yet what the implications are for both the electric vehicle charging network as well as the competitive edge that they have. And Alphabet falling after UBS downgraded the company to neutral. Questions around monetization around artificial intelligence, and that's going to continue.
It'll be fascinating to see the news flow into the summer on Tesla. I have no idea what to think.
I think nobody, well, I think there is something legitimate under it. Now valuations are really the focus. And again, the main question heading into the second half of this year has been, can the biggest rally on record for the first 6 months of a year in tech stocks persist despite the increasingly hawkish rhetoric of central banks?
Google, what do you got?
Google is falling 1.4% because they were downgraded because of monetization risks for artificial intelligence.
Okay, they were downgraded as well. Sorry, I missed that this morning. I was wrong on the banks. Bring up this chart. On radio, it's real simple. A lot of us, including me, believe there was actually a rebound in the banks. At least it's like a dead cat bounce. I had no idea. They just haven't come back, have they?
They have not come back. The peak was $51.20 in January 21. There is an issue right now with the bears. Do they double down or do they get perhaps a little bit more optimistic like Carl Weinberg did earlier this morning? Morgan Stanley's Mike Wilson among those, staying bearish, saying equities are facing a wall of worry which could fuel a sharp sell-off. Quote, the headwinds significantly outweigh the tailwinds and we believe risks for a major correction have rarely been higher. Our target for the S&P 500 is 3,900 for 4Q of 2023. Even though, as people have been saying, the underlying economy looks good for now, Tom.
Yeah, but there's 3,900, but there's a lot of other people below Mike Wilson. Mike's getting all the print, but there's some serious bears out there who, they're being challenged right now, to be polite about it.
Yeah, like Greg Buttle over at BNP Paribas.
Yeah, absolutely. 43.83 on SPX right now. Someone watching this is Amy Silverman, head of derivative strategy, RBC Capital Markets. My head's spinning, Amy. It's like the fifth cross moment. It's out worse than kurtosis and the rest of it. Over the weekend, how did you study the bull-bear debate?
Yeah, obviously, incorporated into the weekend was just the geopolitical news. And I will tell you, coming into this weekend, volatility, Tom, had just been pummeled. One thing we were talking about is just when you look at Apple, which is 20% of the contribution of return to the S&P this year, 20%, it's at a 2, 5, and 10-year low from an options perspective. So, the Birkin of the market is on sale. And then on top of that, now you get this geopolitical instability. What does that mean? It's tough, but I just have to say that when you introduce this level of uncertainty, it's hard not to see, option price levels as quite compelling.
When you see a lack of volatility, a VIX 14.43, we had a 12 print at one point, just as a general amateur statement. How do bulls hedge? Are you able to constructively and effectively hedge your success right now?
Yeah, so that's an interesting question because of the following observation. The one thing that's been happening in options right now is volatility and spot price have actually been positively correlated. That's not normal. So usually, your VIX goes up when your S&P goes down and vice versa. We've been having VIX and S&P go up at the same time. One of the reasons for this is because of those bulls, Tom, because folks are still reaching for that right tail. They're doing it through options, and that's a function of why you're seeing both volatility and spot price rise in some instances.
Amy, how are you tracking the potential tail risks being exploited or expressed following this weekend's events? Are you starting to see shifts in how people are putting on tail risk hedges?
Yeah, so I think we're going to get more details on that kind of later today, Lisa, just because it happened over the weekend. But I'll tell you, I've been in Boston speaking with clients, and this past week before the news hit, it was just kind of this overall statement of, look, volatility is low, but I think we still need to sell it because low volatility does not necessarily mean cheap volatility. And then over the weekend, you introduced a pretty big left tail risk that I think, possibly could be a compelling reason for folks to own it. So you might see that left tail start to get bid again.
We've been talking all morning about one of the biggest questions heading into the second half of the year is whether this tech trade can continue or whether it's going to get retraced substantially. Based on positioning, what's your read on that?
So positioning right now, and, I'll just say, granted, given the political news, this might change, but going into this past weekend, it was still remarkably bullish. So folks were still on that tech train. They were still on that momentum train. And you see that in, that skew inversion, that call demand over the put demand in Apple, in NVIDIA, et cetera. But as I mentioned, you have hedges in Apple costing kind of decade lows. And really the question, I think, is with this breadth of the market, if tech goes, the market by definition goes. And so that's what I think people are going to have to start putting into their thought process going forward.
What are you recommending then? What are you saying is the more likely outcome based on positioning, based on the bullishness? Does that make the trade more fragile or does that give it legs because of the money still flowing in?
Yeah, I think, look, when you start to introduce geopolitical risks like what we're seeing, the one thing is the market tends to be very bad at pricing out these risks from a left tail and a right tail perspective. So overall, if you're going to put tail hedges on some sort of index proxy, like an Apple, for instance, those are quite inexpensive because what happens is if it becomes more unstable, you get a correlated move down. That's what we've seen historically. And that's why, you want to just own anything that could be a proxy to the overall market.
Amy, Lawrence McDonald made a splash, I think it was 10 days ago, with a lengthy essay off the first order mass of index funds, ETFs, all the other 401k stuff we do, and then the Amy Wu Silverman space of overlaid derivative instruments on top of this ginormous amount of money. Do we have opacity or clarity on the notional value of the set of derivative instruments off of our gazillion-dollar retirement base?
Yeah, so this has been a very hot topic, Tom, among derivatives practitioners, because so when you speak to that, the way I'll tell you it happens practically is there's now a lot of money going into funds where, the fund is essentially long stocks, but there is a derivative overlay strategy that's maybe selling calls, collecting premium on top of it. And so what has happened because of that, Tom, is there has been this dampening of volatility overall because there's so much notional going into funds that's selling volatility into an environment that already has narrow breadth. And the question is, this is what derivatives practitioners are asking, what happens when this breaks? What happens when there's big correlated move either to the downside or to the upside? In this case, it's actually a correlated move to the upside that could break this, because remember, it's mostly overwriting. That's where the notional is. And I do think that's why, we fixate so much on the breadth of tech, because if AI keeps going, if that train keeps going, that's where I have the question. But it does seem like, right now that maybe some of the froth is slowly starting to leave the market, at least from price action this past week.
Amy, thank you. What a clinic. Amy Wu Silverman, RBC Capital Markets there. Lisa, this is a huge deal. I just can't say enough about 87. Okay, it happened, and it took 2 days later, we're all like, oh, portfolio insurance, or, 98, or the flash crash, whatever. And as Greenspan articulated beautifully once, we have to have derivative instruments. They're a constructive value to a financial system, but they feed on themselves. And where are we now in the cumulative snowball rolling down the hill of notional top-line derivative value? My answer is we don't know. Amy, I thought was a little more articulate about it.
We don't know. And there's also this issue of people who are trying to get signals from the derivative exposure. You talk about VIX. That's a key example. VIX artificially suppressed because of how people are expressing some of their views in markets, renting it, not buying it.
I mean, I have to see. And, I think the problem is it's very complex. The fact is it's complex, and people's eyes glaze over when they read about this stuff or listen to it. But the fact is it has to be addressed also on the leverage bet, on what the leverage is out there, the underlying, are we going to get out to 20-to-1 idiocy, which usually gets us in trouble.
Well, that's the reason why I think a lot of people are watching the stress tests that come out on Wednesday by the Federal Reserve to understand the leverage being baked into the system that has been made more resilient. If you're just joining the program, you can take a look at the S&P, lower by about 0.1%, a bit of a safety trade. 10-year yields lower by about 5 basis points, 368 right now. I am curious, especially given some of the uncertainty, how some of the biggest banks, Tom, are readjusting, given that they're expecting deal flow to drop off. And there's a changing of the guard at a number of banks.
Well, it's a changing of the guard at a number of banks, but to your point on readjustment, we have yet to mention this. That's how much we're focused on what's going on in Russia. And Lisa, it's simple. Right sizing at JP Morgan, right sizing at Goldman Sachs, right sizing at Citi. There's a trend here into the summer wrapped around the world of Sonali Basak, around investment banking.
That you're going to see deals fall off, trading volumes expected, trading revenues expecting to fall quite significantly just on a year-over-year comparison basis because last year was so great. Then this morning, our colleagues over on Bloomberg News are reporting that Tom Montag is joining Goldman Sachs after previously being one of the top executives of Bank of America, possibly bolstering the David Solomon era, and someone who is not exactly a soft character or someone to have a small presence.
Well, the New York Times, Katie Kelly of the New York Times did a terrific treatment on this 2 years ago, and it was a huge, lengthy story on Tom Montag. And the part of it that I think really captures it and the comfort for Mr. Solomon is, you know, what I did a panel at Davos with Tom Montag. He's a throwback. Okay, there's no, you know, he's a guy from another generation. He's gonna give a traditional message, perhaps, as a member of the Goldman Sachs board.
Traditional message, get back to the office. That's the key question,
yeah,
right?
That's part of it. I was going to deal on that, but he's going to say, he'll certainly say his peace of mind is something we all know from Tom Montag. He returns to his Goldman Sachs. Red and green on the screen. Stay with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think right now they'll just be observant and see what the wider ramifications are. Of course, if this is not the end of it, and I think many markets do not think this is going to be the end of it, of course, there will be repercussions and central banks will then react accordingly. But ultimately, it's about demand versus inflation. And again, in the Eurozone, on the continent, and Russia, of course, will play into this. We are seeing clear signs of a demand slowdown. And I think that's something that needs to be reacted to.
Good morning, everyone. Bloomberg Surveillance. Jeffrey Yu there getting us started. BNY Mellon here. Lisa and I just scouring all the news sources here on a really original Monday. I would say, Lisa, the only idea we can coalesce around here away from speculation is many sources, including Bloomberg, saying the former head of Wagner, I guess, well, like, see, I'm wrong on that. Maybe he's still head of Wagner, still faces charges, says the Russian state media. I'm just quoting from the FT, but many sources have that.
The news over the weekend was that along right-hand man of Vladimir Putin, the Prigozhin, head of the Wagner Group, which has made big inroads in Ukraine, had marched on Moscow been vocal in his opposition against Vladimir Putin, and then come to some agreement maybe to go to Belarus and not be charged. To understand all of the uncertainties and what this means, how important it may be, even amid all of our myriad questions, we are so lucky to have with us someone who has extensive experience over 4 decades in the Army, Navy, and currently as a teacher at the U.S. Air Force Academy. Retired Lieutenant General David Deptula, a board member for Academy Securities, and someone with a storied history throughout the years in a number of different conflicts. Lieutenant General, I want to start with how important were the events over the weekend from your vantage point?
Well, Tom and Lisa, thanks very much. First, what I would tell you, what we've seen is pretty incredible and incredibly significant. The Wagner revolt is an opportunity for the Ukrainians, on the one hand, from both a military and a psychological warfare perspective, particularly if Wagner's combat-hardened troops remain out of Ukraine, that could tip the fight in Ukraine's favor. But there's just so much uncertainty regarding just what is happening out there. The fact of the matter is that Mr. Putin is still in power, and his priority now is staying in power. He's seen this as a chink in his armor, if you will, and now he wants to avoid a spark that weakens and turns public opinion against him. And that has gone into this whole notion of what happened over the weekend. But there are lots of rumors running around. There's one that Prigozhin captured a nuclear storage facility in Russia, which would explain his decision to suddenly end the coup, which was proceeding, frankly, quite well. Moscow may never have been his final destination. The nuclear storage facility might have been. So if, in fact, that happened, which, again, it's a rumor, but once he got where he was going, he ended the operations because his objectives were achieved. We just don't know.
What would be some of your key questions, retired Lieutenant General, at a time when a lot of people are talking about how this likely does benefit Ukraine, but raises the uncertainty about the nuclear arsenal, as you just said? Lieutenant General, what are you curious to know? What would you be looking for to get some sort of sense of whether this is positive in terms of ending the conflict or negative in terms of nuclear proliferation?
Well, excellent questions, and the answers are what I'd be looking at. Where is he? What were his objectives? Is he operating out of Belarus now? There's also a possibility that this so-called Wagner revolt was a ruse to open up a northern front from Belarus into Ukraine. So one needs to understand that deception is a fundamental element of Russian operations. So there's a lot of speculation, but few facts just yet. And that's what we need to do, is hear some of the facts, or at least verify some of the facts, and then we'll be better prepared to understand just what's going on.
Lieutenant General, an honor to have you with us, and it goes back to Colorado Springs and long before Colorado Springs and Billy Mitchell. Many people have linked you to the heritage of the advent of airplanes in America in military. And David Deptula is clearly associated with drones and all the development we've had in drones. Lieutenant General, do these events in Russia and Belarus, do they allow for a better use of airspace by Ukraine, either aircraft or drones?
It's a wonderful question, Tom, and I much appreciate it. First, lesson number one, coming out of what's happened with this Ukrainian-Russian conflict, is the value of air superiority, because neither side has it right now. And what air superiority is essentially the ability to operate freely in airspace one wants to operate at any time in any location. Without that, what you've seen is this conflict devolve to a World War I style slugfest trench warfare. So that's a huge lesson. And I don't want to take a lot of time because I know we don't have a lot of time, but one has to ask why the Russians performed so poorly with respect to using their air forces. It's understandable on the part of the Ukrainians because there's such a small Air Force relative to the Russians.
What's important here, Lieutenant General, is the offense, if you will, given this opportunity, given this chaos, for example, the expansion of the drone system, which basically you invented with full credit to a huge part of our Air Force, against Crimea, or to weaken Crimea, or to signal that Ukraine wants to have a greater dominance in the Black Sea over to Crimea. Is this now the opportunity to use drones to free up that geography?
Well, that's part of it, but once again, a drone's not a drone. That's why some of us prefer the term remotely piloted aircraft. Excuse me. Because there are small ones, there are large ones, there are ones that have the capacity to carry weapons, to carry other systems that can impose desired effects. A good example is that you've seen the small quadcopters, and they do have their role in value. But if you look at systems like the MQ-9 Reaper, that's incredibly capable, and that could accomplish the kinds of things that you're talking about. But we've got 48, 50, 60 of them just sitting in crates here in the United States that could be in the hands of the Ukrainians, but there are policy issues on the part of the United States government that are currently holding those up. And we'd like to free those up and see those get into the hands of the Ukrainians.
Thank you for this brief, Lieutenant General David Deptula with us this morning. People go, who's the guy? Like you think of submarines, Hyman Rickover? This is the guy who did drones. Just that simple. And there's no other way to put it.
You ask a good question about the airspace, given that this has been one big question, why Russia hasn't used their air dominance over Ukraine. Whether that could change in the wake of some of the developments, we don't know. And I thought he did a great job there talking about some of the questions and some of the potential ramifications. But his conclusion was this does benefit Ukraine, and this will make it perhaps give them an advantage in the near term.
A better tape, and I wonder if some of this is over the stasis, at least, and news flow out of Russia. We've had, I'm going to suggest, 4 or 5 hours of stasis off the total chaos of Saturday here, and I think you see it in the tape. You know, it's all, these are little tweaks. I'm not overselling this, but I got red and green in the screen. I've got the VIX not as angsty as it was. I'm trying to help me here. I'm trying to get some glimmers of optimism going.
I feel like everyone was sort of getting into vacation mode. It's been a long year. Everyone's really tired. It's heading into a holiday season for the U.S.
How dare Russia do this to us?
And a lot of people were hoping for a quiet weekend, and then this happened, and all of a sudden everyone had to pay attention to find out whether it was going to bite them in the butt. And this is really the issue right now when we look at whether people care about this. And I think the stasis you're talking about is people are saying, well, if we're not hearing anything for right now, we could just remain on hold and go back to our mid-year assumptions and our potential plans for the upcoming 6 months.
Yeah, we just have to work it out through the morning as well. We should point out ruble. There's 3 ways to look at ruble. It's a little confusing. There's a ruble basket. There's a dollar ruble. There's euro ruble. Euro ruble has the most angst here this morning, weaker 0.7%. Russian ruble, but really back to 15 months weakness after shocking Russia's strength there off the beginning of the war in Ukraine. Please stay with us. Coming up next, Colin Martin, Schwab. This is Bloomberg. Good morning.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Lots happening on Wall Street.
There are so many factors that play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
With the Fed and all these other central banks having tightened policies so aggressively, it does start to bite, and it is starting to bite.
Fundamentally, actually, the economy is very strong.
We are only now getting to tight policy.
We're not clearly at the end of the tightening cycle.
I think the medium-term view is that we get the recession, and that can drive a deeper drawdown.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
And Russia is the big tail risk once again. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John Farrow on vacation this week. And we are looking right now at a time, Tom, when once again, people are not talking about inflation. They're not talking about central banks. They're saying what's going on in Russia and how significantly could this change the course of events?
Or what's going on or not going on. And it's not news. I thought Tina Fordham was great earlier about the counterfactual here, about looking at what is not being said. And this morning is a general statement. It seems to be radio silence from all the geographies of certainly Rostov-on-Don and also Moscow over to Belarus. And frankly, Kyiv, I think, has been very quiet, just letting him stew and see what the news flow brings. And the answers in the last 3 hours, not much.
Yeah, and what we heard over the weekend was the Wagner military group that had been working with the Russian military in Ukraine in a number of different conflicts, that the leader, Prigozhin, marched on Moscow in some defiance against the Vladimir Putin, the president of Russia. And we are looking right now at this idea that people are looking at potentially some sort of tail risk because they think things look pretty strong right now and still are worried.
This out moments ago from the Telegraph in London, Mr. Putin making a video address. I need to be very careful about speech or whatever here. He was speaking to the 11th International Youth Industrial Forum, Engineers of the Future 2023. Lisa, I know you're all over that event. And the answer is he didn't mention anything about the coup. You don't know, you don't know the when of this, the taping of this, etc. But at least there's some form of recent sighting of Mr. Putin as reported by the Telegraph.
Right. And we don't really understand whether this was some sort of coup, whether this was really an issue of just simply expressing displeasure. We don't have a lot of details. What we do know, though, is the fact that markets were so focused on it and there's little reaction in terms of direction to the trade highlights the uncertainty and the stasis at a time of great reset heading into a very different second half of the year.
Yeah, and on the data check, it's simple, folks. I'm going to truncate this because there's so much going on. But the tape is better over the last 3 hours. I think that's the headline for everybody waking up in America and for global Wall Street. There's an improved tape over the last 2.5 hours, I would say. Futures a -3, Dow futures flat, actually green on the screen a second ago. The yields are not as grim as they were. We were in 5 basis points, 4 basis points. We come in a little better right now. Oil up 61 cents. What can I say? You know,
it's a bull market for oil. There you go. Not quite. We are also seeing natural gas over in Europe rising, although off some of its higher gains as people calibrate what this means in the non-news, as you point out, Tom. The fact that Treasuries rallied, to me, is fascinating. The fact that you did see a haven play for Treasuries, even though some people were saying that potentially some of the outcomes could be inflationary. And that raises a question as bonds as a diversifying instrument. Colin Martin joining us now, fixed income strategist at the Schwab Center for Financial Research. Colin, did you take a signal from that once again we have seen bonds reclaim their role as a stabilizing factor and the counter hedge to risk?
Yeah, we think so. I mean, as you alluded to, we saw yields come down a little bit, although they've given some of that retreat back. But yes, we do think when there are concerns like this, when there are risks like that, you see the bid for treasuries pick up. You see yields come down a little bit. There is that inflationary theme a little bit in there, but as Tom alluded to, oil hasn't done too much. And we look at the grand scheme of thing, I don't think that would move the needle too much in terms of overall inflation, and especially anything that the Fed would be looking at. But to get to your question, yes, they do offer that diversification benefit, and it's one of the reasons why we've continued to suggest all investors consider bonds at these levels.
Colin, if it weren't for the Russia conflict, we would be talking about Centro. We'd be talking about the fact that the head of the ECB, the Federal Reserve, the Bank of Japan, and the Bank of England are all going to be meeting on Wednesday to discuss their increasing fight on inflation. Do you think people are understating or overstating how far these central banks are willing to go, not only in how high rates go, but how long they're willing to hold them there?
I'd say understating, both internationally and domestically. Now, we're not expecting a ton more rate hikes from the Fed, but it does seem like one is likely. What we're focusing on is really that length, as you just mentioned. Whether or not they hike once more, twice more, or even more than that, what we're focusing on is the length of time, because I think that's where really tight financial conditions and restrictive policy comes into play. Because it doesn't give households or corporations any type of borrower, it doesn't give you that bailout down the road to then take advantage of lower rates. The longer they hold, the more they can reach their goals, bring inflation down. So we do think the markets are probably underestimating that, although it has adjusted a little bit, where rate cuts have essentially been pushed back significantly.
Ed Yardeni published this weekend, Carl Keatoney over the Death Star mentions it. Thank you, Carl. And it's a basic idea of the wall of money out there. Lawrence McDonald 10 days ago said the same thing. There was a wall of money out there. That wall of money is, of course, 99% at Schwab. We know it. Is there literally a shortage of bonds?
I don't think there's a shortage of bonds.
We're not to Templeton's famous shortage of bonds yet.
I don't think so, not yet. And there's a lot of money out there. We talk a lot about pandemic savings, what's there, what's not. I think a lot of that probably is gone, but we're still looking at wages right now. We're going to need to see wages come down a little bit. We're going to need to see the loosening of the labor market to really see that spending come down to a level that the Fed's more comfortable with.
But just on a retirement basis, are you people optimistic that there will be issuance by corporations in the taxable space, away from full faith and credit? Is there going to be issuance there so we can buy the coupon? Or as John Templeton said iconically 4 decades ago, there will be a shortage of bonds?
I don't think so. If we look at corporate specifically, the amount outstanding in just the investment grade world, for example, we're looking at 6 trillion plus. That's a lot. I wouldn't expect corporations en masse to suddenly start shrinking the amount they have outstanding. I think they'll be cautious in the near term, but we wouldn't expect a shrinking going forward. We look at the big picture in terms of corporate issuance, whether it's loan market, high yield market, you get closer to 10 plus trillion. Wouldn't expect that to shrink anytime soon.
Given the fact that you don't expect a shrinkage, you do expect companies to continue to maintain their leverage profiles, when will higher rates bite? Because they'll have to refinance at some point.
Yeah, hopefully soon. We've been thinking it's going to weigh on these corporations for a while now, and so far it hasn't at least impacted the way the markets are perceiving the risk there. We've seen spreads all across the rating spectrum come down. We saw a little bit of an uptick last week. We're expecting it to be more pronounced in the junk market, but especially the loan market. This is something we've been concerned with. So if you're asking when will they hit the bottom lines here, it's hitting the bottom lines of loan issuers right now. If you issued loans over the past couple of years, you've seen your interest expense double.
Which is the reason why loans have underperformed. And you've seen that in a pretty pronounced way. High yield bonds, though, have continued to rally. And this is a conundrum. If you look around, like what we heard earlier this show, they see things as being pretty good. You see employment as being pretty full. How do you sell off in advance of a crisis or some sort of tightening in credit conditions that will inevitably happen at some point when these companies roll over their debt?
Yeah, that's what we're concerned with. If we look at the outlook, we've seen defaults start to pick up. If you look at Moody's and S&P data, defaults are closer to 3% or so, more than double what they were a year ago. Expectations are for them to rise. I'll go back to my point before about the length of time that rates are so high, where those corporations who might be sitting on the sidelines right now, not looking to refinance or issue debt, they're not going to really be given that opportunity anytime soon. Now, high yield bonds have performed really well this year, and even though we continue to talk about how cautious we are, spreads remain close to 4%, 4.5% area. We still see plenty of indicators out there that suggest they should move higher. What we're telling our clients, we're not saying you need to get out totally. We are saying we're cautious. We expect spreads to rise. But if you hold for a long period of time, you can kind of ride out those price declines, and you can see spreads rise 200 basis points or so and still break even or even make money over a 12-month time frame. We always talk about 12 months with our clients because you want to really earn those annual income payments.
Are you expecting new issuance by corporations when these ginormous companies, Apple or whatever, they'll make 4 phone calls and sell $5 gajillion of bonds? But is there going to be a solid issuance stream in taxable bonds?
I think for IG, we can see solid issuance. I think they can withstand it. They have stronger profiles to do that. I think we'll see a weaker high yield market. I think investors are going to be a little bit more cautious, and I think issuers themselves are going to look at those numbers and decide this might not make sense for me right now.
Colin, thank you so much for joining today. Colin Martin with Charles Schwab. Today, Lisa, I think this is a huge deal for CFOs. What do we do? And the answer is maybe a little less equity and a bigger bond exposure. I don't mean people like auto companies or John Deere where it's part of their customer financing. I'm talking about vanilla industrials, old school stuff.
And they'll get good rates because people are still clamoring for their bonds. You might see lower spreads than people have seen in the past because the benchmark yield is so much higher. It is the other companies that I wonder about, the riskier companies with more leverage. Do they go to the public market? Do they start going increasingly to private markets that are becoming much bigger and richer and deeper as people seek opportunities? These are some of the questions that people are gaming out right now, not calling for a wholesale credit crisis, but calling for an increasing sort of boiling of the frog the longer that rates are held.
Where did this phrase come from? This is like the third time I've heard this in the last couple of days, boiling of the frog.
It's just slowly turning up the temperature more and more and more and more until the frog is no longer with us.
Can't we do boiling a lobster? That just sounds like
it's basically the slow grind is what people are talking about. Because at some point there was a story, we've been writing extensive stories about why this economy hasn't been as interest rate sensitive as so many people thought that it would be.
Yeah, there's some treatment this weekend on that.
Yeah, and this is part of the reason why companies don't have to borrow that actually would have to pay the really high rates.
Yeah, I agree with that strongly, but I'd also say there's a pandemic study. I do want to point out, is part of this pandemic study We'll have full coverage from Centro with a huge focus on Wednesday, right? Wednesday?
Yep, Wednesday is going to be the big confab with all the central bank heads.
Everyone that's going to be there is going to be there, and we'll give you the central bank coverage as they readjust and recalibrate into the summer from Portugal. Futures at -3, the S&P down fractionally 0.1%.
Right now, as we recalibrate heading into the second half of the year, I do think a big focus is going to be on the banking sector, Tom, especially given that they kick off earnings about July 14th, I believe, is when JP Morgan has its earnings, which begins the whole cycle. This is going to be curious at a time when trading revenues are coming down, deal-making revenues are coming down, and lending very much in the forefront at a time of potential credit restraint.
Talk about credit restraints. You know, we want to talk to people that know what they're doing. Publishing moments ago, Anurag Rana, who's expert on the cloud, expert on IBM. Here's his initial take on the acquisition today of IBM of Aptio. You think that's how you pronounce it, Lisa?
Sounds about right.
Aptio, $5 billion transaction. Smart move by the IBM CEO to add more software revenue to the overall sales mix. What I really find interesting here, Lisa, IBM is one of the few large tech companies that can actually get a deal done as regulators scrutinize any move by the bigger firms. To me, that's really interesting. They're like JP Morgan. They're almost boxed out.
Well, they don't have enough of a monopoly on the hot technology, and so they're allowed to make acquisitions. Is that what you're saying?
Yeah, I think they're behind. So they get to make yes. I think they get to make an acquisition as well. Oil, 69.53 here. Foreign exchange has given me no love today. Dollar fractionally weaker. I really thought we'd see more euro, 109.18, Lisa. Just, you know.
Well, is this, I mean, again, we've been talking about this all morning. Is this a tail risk that could potentially bolster the euro or potentially detract from it? It depends on which way it goes, and we just don't have enough information.
It is not enough information, and it has been quiet information through this morning on Mr. Putin and Russia. Coming up next, Ian Bremmer, the Eurasia Group. Stay with us worldwide, Bloomberg Surveillance.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
The climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies. From New York City,
from London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
We've seen some very serious cracks emerge. You have Prigozhin publicly questioning the very premise for this Russian aggression against Ukraine in the first place, the notion that somehow Ukraine or NATO presented a threat to Russia. You have someone challenging Putin's leadership very publicly and very openly. We see cracks emerging. Where they go, if anywhere, when they get there, very hard to say. I don't want to speculate on it, but I don't think we've seen the final act.
The Secretary of State, Antony Blinken, there on ABC this weekend. That seems distant ago, Sunday morning. So much news has changed from Sunday morning and then into relative silence, Lisa, I would say this morning.
Yeah, I guess
some nuances, but it's really minimal.
Yeah, well, what we're hearing is from a number of leaders around the world, the latest being NATO Secretary General Jens Stoltenberg saying the mutiny by Prigozhin of the Wagner Group highlights Vladimir Putin's mistakes. That's been one of the big takeaways, is that it does seem to have weakened his position, at least visually from the outside.
What we are going to do now is speak to Ian Bremmer, president of Eurasia Group. He's author of The Power of Crisis and Far More, Identifying the Risks of the World at the beginning of the year with Bloomberg surveillance, with all the 10 risks of the world, if you will, for 2023. I'm not sure this was on the risk, but here we are amid this crisis.
It was, Tom. No, it was number one. It was just number one. Rogue Russia. You and I were there at the beginning of January.
Well, thank you, and thank you for your guidance and leadership on that. Ian Bremmer, I'm going to go to one statistic now in the Wall Street Journal, Federation of American Scientists. Russia has 1,674 deployed strategic weapons pointed at Europe and other points as well. Brief us on the nuclear risk that we face this morning.
Look, this is the most powerful rogue regime on the world stage today by a very long margin. And Putin, who is facing unprecedented pressure from a disastrous war on Ukraine that he has been fighting ineffectively for the last nearly year and a half, now also faces unprecedented challenge domestically to his own power over the last 48 hours, by far the worst 48 hours since he became president of Russia. This is a man who also controls the largest nuclear arsenal in the world. I don't think I need to spell out more clearly what an existential threat that poses to all of us. And he's a war criminal, and he's thought to be a war criminal by the entirety of the G7, the US, NATO, all of the American allies. It is very hard to find a way back from that, Tom. When you and I talk about war criminals, we talk about people like Bashir and Gaddafi,
right?
And those are people that Milosevic, those are people that end up dead or in prison. But you know, the only way to get from here to there with Putin involves an enormous amount of danger, and that's why the story with Mr. Prigozhin this weekend was so important.
Ian, with your European Eurasia Group coverage, and I'm going to go back, I'm going to pick two presidents, and this is not political, folks, but the angst over Dick Cheney years ago and some of the angst of the military over President Trump. Do you have an understanding of the military command and control of their missiles versus the very focused group in the Kremlin?
Look, I think that we have greater concern about the disposition, not just of Russia's nukes, but also its biological capabilities and its criminal cyber gangs, who are the strongest and most capable of any country in the world. And that's all been, marshaled through Russian state power. And, you know, if you say how dangerous is that today, I do want to remind everybody that, you know, Putin's been tested in an unprecedented fashion, but none of his senior military advisors or government leaders or major oligarchs blinked. None of them defected. None of them came out against Putin and his regime as Prigozhin and Wagner were marching on to Moscow, largely uncontested over the course of the weekend.
Hold on a second.
I don't think we have a reason to believe that there is a challenge to that today, but it's absolutely uncertain going forward.
Do you think that Russia is more or less risky with Vladimir Putin still at the helm of this statehood, given that he is a known entity?
It would have been more risky under Prigozhin, but this is a clear case. I mean, Prigozhin is a former convict, massively emotionally unstable, known torturer, personally responsible for lots of war crimes in Ukraine and elsewhere, also emotionally dealing with being on the front lines and facing the assassination of several close officers around him just in the past months. None of us can put ourselves in his emotional state right now. So, yeah, I think it would have been even more unstable under Prigozhin, definitely. But this is a clear case where the enemy of our enemy is our enemy. I don't think there was anyone in NATO that was rooting for Prigozhin to take over in Moscow this weekend.
How do you read the interference or involvement of Xi Jinping's diplomats, the idea that they actually did hold discussions with Russia, with Vladimir Putin's right-hand men over the weekend, but didn't seem to get involved?
That's right. The deputy foreign minister had a trip that had already been scheduled. They certainly didn't cancel it. China basically discussed this as an internal Russian affair, which is pretty close to what NATO had to say. Putin facing the worst challenge of his career, and his best friend on the global stage, Xi Jinping, offered no military support, offered no direct defense. I mean, you don't usually talk about Kazakhstan, but I'll mention it. A year and a half ago, before the Russian invasion of Ukraine, there was a coup in Kazakhstan, and Putin sent 2,000 paratroopers to help keep President Tokayev's chestnuts out of the fire. And then just over this weekend, he said, hey, this is a Russian matter. I've got nothing to say. Putin really does not have real friends on the global stage. A lot of people want to buy his oil for cheap. A lot of people prepared to do business with him. Not a lot of people prepared to take any domestic risk to help him.
Ian, is this an opportunity, given the shock of all this? We have no idea what's going to happen in the next 12 hours or 120 days. But is this the save-face moment where Turkey welcomes Sweden into NATO? Is it a big enough deal where it's a change agent for a successfully elected Erdogan?
I think that was going to happen anyway, but it probably happens more quickly now. I saw Stoltenberg from NATO make some statements in that direction in the last 24 hours. This is also an opportunity for the Ukrainians. They only have about 2.5 of the 11 divisions that are in position and fully outfitted and trained by the Americans, by the UK, have been fighting in the counteroffensive thus far. They will certainly be more optimistic about being able to take more land. That counteroffensive had not gone very well over the past few weeks. So that's an opportunity. There's also the fact that Wagner Group is being liquidated. Their headquarters were raided over the weekend. Their soldiers are going to have contracts for the Ministry of Defense. The ones that were involved directly in the fighting against Moscow, I'm sure are not going to be fighting going forward. These men, a lot of them are former criminals. They're not trained. They're brutal in the field. They're more likely to engage in torture and other sorts of horrendous behaviors. The fact that Wagner's being liquidated is good news for the world. It's for Russia, for Ukraine, but also for countries like Mali and like Libya, where the Central African Republic, where they've been operating. It's a very good thing that the world's most powerful paramilitary organization with no oversight other than Putin is gone today. That's a good thing.
Dr. Bremer, thank you so much for your time this morning. Ian Bremer, of course, of Eurasia Group. I did not remember that. Of course, Ian remembered it because he wrote it up, and I guess it is a victory lap, but he said it was the first risk this year in the top 10 risks of January. I do not remember it.
About that. They said there was a real instability in the biggest nuclear arsenal out there, and that was a big concern.
Yeah, it is.
Just to give you a sense, coming up on the Open, we'll be joining with Troy Gajewski of FS Investments, JP Morgan, Stephanie Roth, and John Mackay of Schroders to talk about some of the machinations after potential geopolitical risks, but also uncertainty economically as the world's leading central bankers head over to Sintra.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Bloomberg Surveillance, good morning, and we say good morning worldwide to you. Jonathan Farrell, Lisa Bramowitz, and Tom Keene. Lisa getting ready for a 9 o'clock soiree with important guests on Russia. I do want to point out in the 10 o'clock hour, Bloomberg and Alex Steele and Guy Johnson will speak with General Ben Hodges, retired of the U.S. Army. Really looking forward to that conversation as we talk to the gentleman from the Air Force, the Lieutenant General here. In the last half hour. The tape is better. That's what you need to know off the shock of all of the international events of the weekend. There was, I don't want to overdo it, a wait to the tape Sunday out of Asia into our morning, and it has improved. There's no other way to state that. I've got fractional green on the screen in a NASDAQ 100. Dow, SPX is 0, essentially. That's very important. But just as important, the 2-year yield space improves a little bit. What has not improved is curve inversion. Right now, I've got a true 103 basis points on the 2s10s spread, and that is really something, and that is a source of study for our next guest. I got a huge response the last time Michael Darda was on. He's chief economist, macro strategist, Roth, MKM Partners. We're going to revisit today and really focus on some of the certitudes out there and the lack of patience over watching recession indicators. Mike Dowder, thank you so much for joining. We see this shocking curve inversion now, re-invert almost through March maximum inversion on the vanilla spread, the 2s10 spread. You look at other spreads. Why are we impatient on the signals of inversion?
Thanks for having me on, Tom. I think we're impatient simply because the yield curve is a long leading indicator with a lot of historical variation between inversion and subsequent recession. Based on the 10-year to 1-year Treasury spread, that's the one we focus on, recessions have occurred anywhere between 7 months and 25 months post-inversion, with the average outcome 12 to 14 months. So we're 11 months into inversion on that specific yield curve. And so it's just premature to say, oh, the statute of limitations is now up. We've been inverted for too long and the economy is held up. We are slowing. There's no doubt about that. But the recession debate continues to go on. But this always happens, Tom. You've been around for a couple cycles now. When the yield curve inverts, the macro data and even risk markets, do tend to hold up for some time. And so the perception is it's different this time. It's a false signal. And the it's different this time phrase is really the most dangerous in economic forecast.
As we move forward, do we disinflate?
Oh, no doubt about it. You can already see that in this slowing trend for nominal GDP. And in fact, on the income side, nominal gross domestic income is essentially flatlined. We're negative now 2 quarters in a row on GDI. And so that divergence is something to keep an eye on from a recessionary perspective. The last time we saw divergences between GDI and GDP was just before the 1990-91 and 07-09 recession started. And so we can see that deceleration in the nominal aggregates, and inflation tends to follow the business cycle. It's a lagging indicator. So wages and especially rents tend to be tied to leases and contracts. So specifically the core inflation rates, they are coming down, but they're still elevated, and they will continue to come down on the back of slower nominal spending. And that's really the key variable as to whether the Fed has tightened or eased. Is nominal growth decelerating or accelerating? It's decelerating and decelerating sharply, and there's more deceleration ahead.
Well, this is critical, Michael Darda, on nominal growth, adding real GDP and some form of inflation statistic. Are you suggesting we get to sub 5% nominal GDP? I think a lot of people out there aren't expecting that.
We're already there, Tom, on the gross domestic income figures, and those tend to be a better barometer of where GDP will be revised to in the future. So we're limping along at barely 1% annualized nominal for GDI. Now, nominal GDP is still up in the mid fives, or if you take like a 2 average a bit higher. So, a 4% trend would be consistent with about a 2% inflation rate. And I think we're going to get there, if not fall below that, in the near future.
Just surveillance warning on a Monday. This is what happens when you have someone from the University of Wisconsin on. They go all GDI, GDP on you. Darda was the only one in his class who actually passed the exam on GDI when he was like 17 years old. Michael, let's translate this to the stock market. There's a P, there's an E, or maybe there's a P and there's a cash flow. A lot of people are focused on earnings lessening or flattening. Even if I get earnings flattening, can I get multiple expansion?
Well, you have been getting it this year. I mean, this run up in the equity market has largely been driven by the multiple. And in my mind, I think that puts us in a bit of a dangerous place because at a 19 times forward multiple on the S&P 500, with elevated recession risks still in front of us, I don't think that's a particularly good risk reward for most investors. If we look at what's driven the S&P 500 this year, obviously it's been this outperformance in a handful of growth stocks. So the Infotech index is actually up at a 27 multiple. We haven't seen anything like that since late 2021, Tom, and that just preceded a more than 30% collapse for the sector. Now, because market interest rates are higher than they were in late 2021, the equity risk premium on the Infotech sector is actually negative for the first time since June of 2007. Also, not a particularly good time to be running with the bull.
Michael Darda, thank you so much for the guidance. He's with Roth MKM. Michael Darda there with some real caution from a guy who's congenitally optimistic, so that's a challenge to say the least. I got a little bit of a lift to the tape all around, seeing a better stock market futures with SPX exactly flat, Dow a little positive, NASDAQ up fractionally as well. Don't want to make too much about it as we wait for news on Russia. There was a bombshell this morning on Wall Street. I had a wonderful panel years ago at Davos with Mr. Montag of Bank of America, and he is a straight-talking, different person. Shonali Bassick knows this. He's a cut from a cloth from another time. She's our Wall Street correspondent on this. Did you see this coming, that Mr. Montag would go back to the mothership?
No, to your point, he had worked at Goldman Sachs, left for Bank of America, helped make it a trading powerhouse.
Some would say saved it. Let's not mince words.
But remember, when he left in 2021, it was after a string of news that really questioned the culture under Tom Montag. There's a few things going on. It's his grand return to Wall Street, the board of Goldman Sachs. There's only about just over a dozen people already on on this board, very closely knit board, at a time where there are a lot of questions about the culture at Goldman Sachs. Remember, we're only a couple of weeks away from a story that was in the Journal entitled Goldman Sachs is at war with itself. So does Tom Montag, who has long worked with David Solomon, seen as a closer ally to him, start to bring the bank back together and really secure the idea here that David Solomon can bring the ring
in the upset of Goldman over the last 3 or 4 days, and we're not going to go into all those soap opera about it in that, Solomon was at Bear Stearns, and then he and Montag know each other, right? Mm-hmm. So Solomon brought him back. In that process, who does Solomon go to say, I want the guy from Bank of America to come back to Goldman Sachs?
Well, it's interesting because it's not just Solomon. Yes, he's the chairman of the board at Goldman Sachs, but there is still an entire board here. Yeah. And you think about, who are the key players? One of those very key players is the secretary to the board, John Rogers, who has worked for CEO after CEO over at Goldman Sachs. And the sense here is that you really can't lose his confidence. Goldman Sachs is not going to make fickle decisions here. Yes, there were huge pivots in strategy. Yes, there's been a lot of griping, but this is year 5 for David Solomon, so certainly a sensitive time.
Of Kate Kelly's article in 2021, huge long article, and Tom Montag is a dinosaur from Wall Street. He's like a dinosaur like me. He's doing better than me. But Montag from another time and place talking about work from home and all that. He was dead set against it. What's he going to bring to the board? He's not going to tell them how to construct swap contracts.
Well, one thing that's interesting, one is just confidence in David. That's number one. Number two, and this is, by the way, a very astute way to explain the story here from the scoop from Sridhar Natarajan and Catherine Doherty, because remember, this is, again, a question of the next 5 years at Goldman, not the last 5 under David. But remember, while we talk about consumer, you talk about it all the time, it's a drop in the bucket. It had been a drop in the bucket for Goldman's revenue. They had been performing and beating on their core business lines. They have expanded their lead in mergers and acquisitions in the last couple of years. Their trading desks have done extraordinarily well, although
then what's the problem? This is what I don't get. I mean, over the weekend, there was a lot of gossip, just outright gossip, which we don't do, on this bank. And all of it centers around, OMG, David screwed it up. Has he?
Well, the gossip has been for months, isn't it? Not even just this weekend. I don't know if you've been hanging out in the Hamptons too, Tom. I know you like to talk about it. But at the same time, remember, there's a question of why does Goldman need to be something else? Why can't Goldman just do what it does best? Win at trading, win at investment banking. I think that's currently the existential question for Goldman.
I mean, what is Montag going to do on the board? I don't understand. David Viniar, I got an idea what he does on the board. The former CFO. I get that. What does he do on the board?
Well, it's
cheerlead?
Pretty much. I mean, listen, one of the big questions here is we've heard this griping that came out of Goldman for months now, right? A lot of leaking to the press, a lot of issues. Yeah. But the question here is, when do those problems become an actual business problem for Goldman Sachs? There's a sense here that there needs to be a bringing of people together to stop the complaining and to stop the leaks so that this doesn't become a bigger problem.
Was he pushed out of Bank of America? That's sort of, in Kate Kelly's story, it's sort of a variable here. When you talk to Sri, I mean, they go out for drinks, folks, like they work, Sonali works like a 6-hour day and heads out for beverages. And there's the gossip. Was he pushed out at Bank of America?
So 2 things here. I went back to see exactly how this had happened. And remember, when he had stepped down, he wasn't the only one to step down. Ann Finucane had stepped down around the same time. And it was painted as a way to kind of clear
generational
the room
thing
for the next set of ranks. But remember, it did come in the wake of that very, very explosive story, to the point that not only Bank of America, but Brian Moynihan, the CEO of Bank of America, had publicly defended Tom Montag pretty seriously. And remember, these weren't just work from home issues. There are questions about whether women were allowed to be objectified in that culture. There were people who were afraid of losing their jobs.
We will see. We've got red and green on the screen right now. On the NASDAQ 100, I got a very constructive tone to the tape. This off of 4 or 5 hours ago. We're waiting for news from Russia. Maria Tadeo in Brussels looking at that very carefully. The Standard & Poor's 500, fractional down 0.3%. We say good morning to all of you on Bloomberg Radio and Bloomberg Television, in conversation with Sonali Basak, our chief layoff correspondent. Over the weekend, if there hadn't been Goldman Sachs, if there hadn't been all of the international relations in Russia, there would have been no other topic. JP Morgan, Citigroup, Goldman Sachs, layoffs. Are they just getting out front of a very difficult summer? Is it a summer of our discontent?
The part that is so disheartening for so many people is, remember, Goldman set out to cut many thousands of jobs. And when they initially did that at the end of last year, early this year, there was a sense that they're going deep so that they don't have to go deeper. So to see these additional job cuts over at Goldman Sachs, and then to see Citigroup and JP Morgan make the cuts by the dozens, it's surgical, isn't it? We're not talking about thousands of people being cut again. But yes, this is happening in fits and starts. And the worry here is, how far does it go?
What's the character of those managing directors? I mean, is it all IB? Is it all the SPAC crew out? You four guys, you do SPACs, goodbye.
There's a lot of that, but you can also say a lot of that has already happened. And so remember, deals themselves have been muted. A lot of types of underwriting have been muted. IPOs are really only just starting to come back. And people had hired so intensely in previous years. At what point does the market come back that dramatically to have all these people on staff? I will say there's also a lot of movement, Tom, in the positive direction. You're seeing a lot of star bankers starting to move around to different firms. So not all is bad out there, but it's a tense time.
Shonai Basak, thank you so much. Sri Natarajan with an important story here, and Mr. Montag retired from Bank of America, going back to Goldman Sachs on the board amid industry layoffs, to say the least. Futures at -2, the 10-year yield 3.68%. On radio and television, this is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
When you start to introduce geopolitical risks like what we're seeing, the one thing is the market tends to be very bad at pricing out these risks from a left tail and a right tail perspective. So overall, if you're going to put tail hedges on some sort of index proxy, like an Apple, for instance, those are quite inexpensive, because what happens is if it becomes more unstable, you get a correlated move down. That's what we've seen historically.
Amy Wu Silverman, she was outstanding, folks, on notional derivative value. This is an inside baseball, Global Wall Street item right now. If you are part of Global Wall Street, go look for our full conversation with Amy Wu Silverman today. She was absolutely brilliant on the derivative buildup that Lawrence McDonald wrote about 10 days ago that was such a kerfuffle over a given weekend. Really can't say enough about that conversation. We continue strong on the surprises of this 2023 market. Gina Martin-Adams joined us. She just put in a buy order for 100 shares of NVIDIA to get her Monday started. She's chief equity strategist. I know, Gina, you've never seen anything like this. I'll cut to the chase. For mere mortals that don't own NVIDIA, is it broadening out?
Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broadening out? Is it broa
In fits and starts is the best answer that I can give you right now, Tom. What we've gotten so far this year is anomalous, but not completely historically anomalous. There were 2 other periods in time in which we saw the top stocks in the index outperform to such an extensive degree. 2020 was one of those times. In that bull market of 2020, we did see very concentrated gains ultimately broaden out as economic recovery came to the fore later that year. So it is possible we will continue to see broadening. Many people are simply looking back at 2000, which was the other instance of concentration risk, such as that which we have experienced so far this year. And in that case, of course, we had the opposite scenario where ultimately those flying stars started to crash down to earth. So many are fearful of that. We actually do think we will see some broadening. We saw that in early June. Much of that broadening has been offset by some downdraft in some of these high-flying stocks. And I think as we go through the rest of this year, we'll see that 2024 should look like a better economic year than 2023, and the result will be a broadening equity advance.
Gina, part of the CMT, the CFA curricula is real simple. Study history. And one of the great histories, as Amy Silverman alluded to earlier this morning, is the shadows, the opacity of the derivative structure. Are you concerned, and is Bloomberg Intelligence concerned, about the derivative leverage or notional value overlaying our core equity holdings? Are there excesses in 2023?
Look, I think that as market cap accelerates, derivative exposure accelerates as well. And in particular, in this kind of climate where we have very little visibility as to where the economy is going, very little confidence as to where the earnings stream is going, a lot of uncertainty with respect to interest rate risk, people are not taking long cash positions. They're actually playing on the margins, and that's resulting in this derivative bubble, if you will. I do think, though, that as the year progresses, what we'll find is the confidence does start to improve, and that creates some general broadening of exposure, some greater confidence in the outlook, which allows people to take longer-term positions rather than a lot of these short-term playing around the margins. So I think that a lot of it depends upon how we move going forward. If we end up with a very onerous response to higher interest rates, which includes a bigger crash than anticipated, we could be in trouble because a lot of those exposures have to unwind. Right. But I do think that generally, as long as the economic outlook goes as the consensus anticipates, which is a very modest recession, followed by recovery into 2024, the market sort of structure should shift a little bit, and investors should get a little bit more confident taking those longer term exposures, investing in stocks again. We just haven't been there this year.
You know, I had it up earlier. Apple, we're on the 3 trillion watch. It's 2.936 trillion for Apple. They're not even up, folks. They're up like 40-some% versus others to the moon as well. Do you acquire marginal shares in tech? I mean, I know you don't do buy, hold, sell.
Right.
But what are your thoughts if somebody says, OMG, I've got to sell tech? How do you respond to that?
Yeah, I think, frankly, at this stage in the cycle, there's a lot of actually fundamental support for the tech call, the tech broad call. Now, this is not specific to stocks, and certainly Apple and Microsoft are very large entities within the tech space and do tend to drive a lot of those trends. But what we're detecting in our sector scorecard, which is, you know, a very quantitatively driven model that allows us to find for best potential performance among sectors, this sector scorecard does promote tech as well as communication stocks, as well as consumer discretionary stocks and industrial. So those 4 segments are toward the top of the scorecard. The reason why tech is toward the top of the scorecard is because there is an underlying earnings recovery emerging. Remember, last year was one of the worst years ever for these stocks' performance. Tech, communications, all of them underperformed. The biggest stocks in the index underperformed throughout the entirety of 2022. So some of 2023 is just a bounce back. But also, we had a tremendous earnings recession in this space. Earnings fell by 20, 25, in some cases 30% throughout 2022, and we're starting to see earnings recovery emerge. So what we've got in the stock prices is, you know, a reflection in large part from what 2022's experience was now happening in 2023, and also a reflection in the earnings cycle and an inflection in margins for this space. And that's creating a degree of optimism. Frankly, that's supported by fundamentals.
I mean, I look at the fundamentals, and to me, I'm going to link them back, as Michael Daugherty did moments ago, to the gamble, the bet, the speculation, the hope even, that nominal GDP will collapse. What is the Bloomberg Intelligence revenue growth model relative to the boom revenue in selected areas of the pandemic, or frankly, back to 2019?
Yeah, I think this is a really good point because revenue is a risk into the second half. And we've got this really unique experience right now where most of the recovery in the earnings stream that's likely to happen into the second half is because margins recover on account of that inflation downdraft or that deceleration in inflation, which has been really key to creating some margin stabilization. At the same time, revenue growth does decelerate significantly. Our models suggest that actually the offsets of those things results in about a 5% downdraft in earnings growth over the course of the next 12 months. Recall, this is in addition to the already 10% downdraft that we've experienced when we exclude the energy sector or when we look at S&P 500 earnings on an unadjusted basis. So this is a persistence of a recession as opposed to suddenly we're falling into recession. And that timing is very, very consequential for stocks. Remember, stocks follow earnings, they don't follow the economy. So even as the economy decelerates, if you've got revenue decelerating, but that's offset by some easing inflation pressures, your impact on earnings growth could actually be net positive. And I think that's going to emerge into 2024. That could be what the market has been trading on so far this year, is this idea that the earnings distress that we experienced over the last 12 months really comes to an end and comes to an end before the economy starts to turn over, at least if most economic forecasts are true.
Gina, thank you so much. Gina Martin Adams with an equity brief there. As I said last week, my head was spinning, and one of the great foundational beliefs of Martin Adams, you've got to be in the market. You know, we welcome all of you worldwide on Bloomberg Radio and Bloomberg Television. We've been trying to talk to individuals about the belief forward given hugely small news flow. Was there speculation over the weekend? Yes. This morning, there's any number of themes and then silence. For example, one theme out there is that the gentleman from Wagner, Prigozhin, will face charges. It says Russia state media, that from the FT. Bloomberg has that and others have it as well. And there's also the idea, the uncertainties there of where everyone is right now, including Mr. Putin. Maybe some of these answers will be given to us through the days. We've lined up a terrific number of guests. I do want to commend you in the 10 o'clock hour. Ben Hodges will join us, the former general of the United States Army. Alina Polakova will join us as well. She's brilliant, with huge value out on Twitter over the weekend. Ian Bremmer joined us an hour ago, and he has just published his Monday note. And he has a concept here. I don't think it's original to Bremmer, but it's something that's certainly he and Eurasia Group are expert on. And that is the near abroad. And without question, what I have to study forward is this interesting Belarus to the north of Ukraine, and clearly the near abroad for a struggling Vladimir Putin. A major shout out from John Farrell, Lisa Abramowitz, and myself to our team who worked tirelessly through the weekend to bring you our expert voices. Futures -2. This is Bloomberg Surveillance.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not
stock experience with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
From New York City for our viewer worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. Right now, we are looking at complete stasis as the world watches to try to understand what's going on with Russia. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Coming up, markets on edge with traders preparing for the second half as fresh geopolitical uncertainty emerges out of Russia and global central bankers warn of more rate hikes. We begin with the big issue, investors digesting the rebellion in Russia.
It's been a roller coaster weekend.
The issue is around Putin.
A lot of uncertainty.
Uncertainty on the Russian side.
Uncertainty, volatility for the markets.
Traders this morning just acting a little bit on the side of caution.
There is a real air of caution and pause.
There is certainly a negative indirect impact that we have seen. Market reaction very muted.
Markets now need to contemplate what the future holds.
The longer term ramifications.
There is some doubts.
Some worries perhaps about supply.
We could see a surge in commodity prices. This is all very fluid.
A massive chess game, geopolitical chess game.
If escalation were to increase, things could change.
I don't really think anyone really knows what the next move is going to be.
We don't have a clue about what can happen next.
Bloomberg's Maria Tadeo and Anne-Maria Hordern joining us now with more. Maria, I know you've been speaking with people over in Europe. Where is the main concern right now? Where is the balance of logic where people are basically honing in on in terms of the ramifications of what we saw over the weekend?
Look, there's a lot of question marks in terms of this deal. And the deal, of course, I referred to that alleged compromise that was reached out on the Saturday and negotiated by the head of Belarus, Alexander Lukashenko, between Vladimir Putin and Prigozhin. This deal is a reason fundamentally why Prigozhin and Wagner allegedly pulled back from Moscow. And the idea is that nobody would be prosecuted. There would be a sort of amnesty, and Prigozhin would head to Belarus, which, of course, is an independent, in theory, separate country to Russia. Now, today, the Russian state media, however, says that they have not dropped the investigation into mutiny, and there are serious questions as to where it is or what are the whereabouts of Prigozhin. I think the other big quick question, that was made clear by the Secretary General today is this has ramifications in terms of what happens with Wagner and this group of mercenaries, which not only operate in Ukraine, but in a number of places in the world. The Secretary General also repeating Again, this is what happens when you have mercenaries fighting your war. And again, a message for NATO as far as NATO is concerned. The key point now is to keep supporting Ukraine at this stage. Whatever they need, allies should now provide it.
And Marie, how much in Washington, D.C. is that the takeaway, that this gives Ukraine an advantage and to continue doubling down at this point? Or are you hearing a slightly different tone from the people in D.C.?
Well, I think Washington administration does think this opens the door a bit more for Ukraine to make strategic advances when it comes to Putin's invasion of their country, specifically because now, as Secretary of State Antony Blinken put it on a number of Sunday shows over the weekend, now what you have is Putin dealing with tension and the most serious threat we have seen on him and his power since he came to power than he ever has. So he is dealing with a lot of internal politics. Many and what we play over the weekend was chaotic, a spectacle. Russians also lost their lives in what happened over the weekend. So now Putin's attention is going to have to be split. And that is why they think there's potentially this opening for Ukraine. But as Maria says, there are a number of questions that still remain unanswered regarding what happened in terms of this deal and where does this leave Putin and his military. Some analysts I'm speaking to also say potentially this will mean that Putin is going to become even more of a hardliner and really double down his aggression in Ukraine.
Which is the reason why Ian Bremmer was talking about the nuclear stash and was concerned about it. Maria Tadeo in Brussels and Marie Hordern from Washington, D.C. A fabulous team. Thank you so much for that update. Let's continue the conversation now with J.P. Morgan's Stephanie Roth and John Mackay of Schroders. John, how much are you shifting any of your views based on what we saw over the weekend in Russia?
I think it's a very, very hard thing to do. It's a great question, Lisa, and thanks for having me on. I think probably the easiest thing you could do at the margin is maybe increase commodity exposure. Gold obviously is always a good geopolitical hedge. Geopolitics generally doesn't matter until it does, and it obviously mattered a lot over the weekend. It seems to have abated as news has emerged that obviously Prigozhin has removed himself and gone across the border. But I think Anne-Marie hit the nail on the head, right? This could, increase the likelihood that Putin does something more aggressive, at the very least weakens his hold on Russia. So I think commodities are probably the easiest thing you can do at the margin to hedge a continued rise in geopolitical risks.
This is a key question, Stephanie. At what point do we see some sort of inflationary or disinflationary force from this type of conflict if Ukraine possibly has an upper hand in the conflict, or alternatively, some sort of ongoing conflict in Russia really does take barrels of oil off the market?
Yeah, it could certainly have an inflationary impact from a headline CPI perspective, but it would also at the margin slow down growth in the future. And I think the really important message for investors is adding core duration fixed income really makes sense here, because recession risks are rising. They've been elevated for quite some time, and this is just another reason to be more defensive in portfolio positioning.
That is something that I know Morgan Stanley's Mike Wilson has been agreeing with for quite a while. He warned over the weekend that U.S. equities face a wall of worry, writing, quote, "The headwinds significantly outweigh the tailwinds, and we believe risks for a major correction have rarely been higher. We believe the next leg will be about deteriorating pricing and top-line disappointment." John, we heard Stephanie there basically agreeing with a sort of defensive positioning, albeit not necessarily with exactly this call. John, do you see it the same way?
We do, and look, I think Mike wrote that note, and I'm making a bit of an assumption here, but I think he wrote that note before knowing that there was this attempted coup attempt in Russia. So I think at the margin, the reasons he's citing are fundamentals are going to deteriorate over the remainder of this year. The price you're getting paid for the fundamental outlook is not good. And so you need to reduce exposure. I'm sure there's plenty of other reasons he cites in that report, and we would agree with that. I think if you look back at the beginning of this year, obviously the outlook was pretty bearish. I think sentiment has shifted quite a bit to quite a bullish outlook, hopes for a soft landing, and we don't agree with that. We still think a recession risk is fairly high in the U.S. It's been pushed out a little bit given the strength of the consumer, but it's still probably going to happen in the fourth quarter of this year, and a recession will lead to weaker earnings, and you're trading at 19.5, almost 20 times future earnings. On the S&P, you're not getting compensated for that risk. But I would say, and we have been saying for the past year plus, is this new environment, this new regime we're in of higher, stickier inflation means you need greater diversification. And I know that sounds like shoulder shrug, we've heard that before, but you've seen markets like Japan do extraordinarily well this year, and sort of it's a forgotten market. No one's talking about it much. the DAX, the CAC 40, Germany and France have done better than the U.S. this year. So spreading your bets a little bit in this time of uncertainty, we think makes a ton of sense.
Stephanie, from your vantage point, you were talking about some sort of slowdown and the need to be defensive. What are you looking at to determine that at a time when Carl Weinberg of High Frequency Economics earlier this morning on Bloomberg Surveillance said that he is the most positive on the U.S. economy going back to the 1960s because of employment and the strength of the consumer?
I think it's hard to be really positive looking forward because the Fed is trying to engineer a slowdown. So they're raising rates, keeping them elevated at above 5% for quite some time, and that's going to have an impact. They're going to get a slowdown one way or another. And if we don't get that slowdown, the Fed's just going to have to keep hiking. So risks remain quite high. But we are getting closer to the Fed pause, which is an important thing. So what are we looking at there? Employment needs to slow down into the 100s. It's currently around 200,000. We need to see continued signs that rates are restrictive. That's the case. Banks lending has certainly slowed down from where we were last year. And we need to see continued signs that inflation is cooling down. So we've gotten some of that. I think claims are going to be the most important thing to watch. They have certainly risen over the course of this year, and that's one important sign of cracks under the surface.
And John, this is the reason why diversification becomes so complicated, as I'm sure everyone's been talking about, but you say that it's important to diversify your portfolio, and yet if the Fed, if the ECB, if the Bank of England, if the Bank of Japan, or not the Bank of Japan, they're their own story, but the rest of them who are meeting in Sintra this week are talking about the potential for higher rates for longer, then are bonds truly a diversifier at a time when stocks, as you say, look a bit heady in valuation?
We think they are. I mean, the yield you were getting paid at the beginning of last year didn't compensate you for higher yields, right? The risk of rates rising, you're getting compensated for that now. So the impact of if we're wrong and if a slowdown doesn't happen and the Fed keeps rates higher for longer along with other central banks and rates rise from here, it'll hurt, but it's not going to hurt you nearly as much as it did last year. So we would agree with Stephanie. We think it's worth taking on some duration. The other thing I'd keep in mind is at the beginning of last year, obviously Fed funds were at zero, 10-year Treasury yields were significantly lower than they are today. The market sold off on the fear of rising rates having an impact on the economy. We now have those higher rates and everyone's kind of blasé about the impact on the economy. It just doesn't make much sense. Those two things just don't, they don't tie together. So our view is get slower growth. That should result in longer yields, probably falling a little bit further from here. But I think the key there is they're not going to fall back to zero. We're not in this environment anymore where the Fed's going to be able to step in. We see weakness in the economy, weakness in the markets, and they cut rates immediately because of higher inflation. So it's a much more difficult environment than we've been in for quite some time.
Stephanie Roth, John Mackay, both of you are sticking with us. Let's take a look right now at some of the stocks moving ahead of the opening bell. Abigail Doolittle joining us. Abby.
Hey, Lisa. Well, overall, we have stock futures basically unchanged, down ever so slightly. But to the upside, PacWest, they sold $3.5 billion worth of asset-backed loan portfolio to Ares Management, boosting the company's liquidity amid continued concerns on deposit outflows. Lucid also higher, sharply higher, up nearly by 9%. Aston Martin joins with Lucid in a Saudi-backed EV partnership, has also sent Aston Martin soaring on the possibility of something new for both of these companies. And then finally, Tesla, not so much, down 1.9%. One of the big drags on the market this morning, cut to a neutral from a buy at Goldman Sachs on a tough pricing environment. Plus, as you know, Lisa, this stock has already more than doubled in 2023.
Just some small gains. Abigail, thank you. Coming up, central bankers warning of more rate hikes.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go.
That conversation coming up next from New York. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go.
Additional policy rate increases will be necessary to bring inflation down to our target over time.
We're very far from our inflation target of 2%.
I expect that we will need to increase the federal funds rate further to achieve a sufficiently restrictive stance of monetary policy.
It will be appropriate to raise interest rates somewhat further by the end of the year.
Fed officials ramping up the hawkish rhetoric as Governor Bowman calls for better supervision of U.S. banks ahead of their stress tests that come out on Wednesday, saying, quote, "We need to consider whether examiners have the appropriate tools and support to identify important issues and demand prompt remediation. Increasing capital requirements simply does not get at this underlying concern about the effectiveness of supervision." Bloomberg's Ira Jersey joining us now for more ahead of a very busy week, particularly on the central banking front. And if it weren't for Russia, Ira, we'd be talking about Sintra and how all the central bankers, the major ones from around the world, are getting together. What are you looking for in terms of a united hawkish message from these central bankers coming out on Wednesday?
Yeah, I think with the UK and the US seeming like they're going to hike a little bit more, it'll be interesting to see what the ECB and some of the other developed market central banks to suggest at some of these discussions that they're having. I think from a market perspective, it's interesting that some of the most important information we're going to get is going to be in the middle of the night in the U.S. So, for example, Powell this week at one of the panels he's going to be on is going to be on at 2:30 in the morning, New York time. So, so a lot of the market moves may happen overnight. So we have to be aware that that when we come in the morning, we might see some pretty dramatic moves depending on how hawkish or seemingly dovish some of those comments might be.
Ira, what's your sense of the duration of how long these central banks want to hold rates high versus how high the rates are going to go? How unified they are in their belief that the duration is more important than simply the terminal level?
Well, I think there's two parts to that, Lisa. I think firstly that most central banks really want to make sure that inflation is trending lower toward their various targets, which for the most part is 2%, depending on which measure of inflation that you're looking at. So for the Federal Reserve, I think that means that you're still looking at well into 2024 before we get there. And in the summary of economic projections, the Fed even doesn't think that they're going to get back to that 2% target till 2025. So the Fed might be pretty reluctant to start cutting interest rates at any point really in the next 18 months unless it sees a very significant uptick on the unemployment rate or a significant reduction in inflation that seems like it's going to hit their target. So they've been trying to hit on that, but the market has not believed that the Federal Reserve and indeed some other central banks will be able to do that because the market seems to think that there'll either be an exogenous shock or that the economy will weaken enough that it'll start to that they'll be forced to actually cut interest rates earlier maybe than they would like to in some of their projections.
Ira Jersey, thank you so much. Still with us are Stephanie Roth and John Mackay. And there is this question as we talk about tightening policy, how far and for how long? Stephanie, you were talking about how they do want to kill some of the momentum in the economy. They want to induce some sort of downturn. Why do you think this economy has been so resilient to higher rates so far this year?
I think it's been partially driven by the consumer, and this is all related to the labor market. The labor market has been really, really strong, largely driven by the service sector, so leisure and hospitality. That's been a really important driver, and until you start to see a real weakening in the labor market, the consumer is going to just keep spending. And on top of that, they've started to take out a little bit of debt. So you've seen credit card loans pick up a little bit. So once you do start to see weakening in the labor market, then the economy will slow down and get the Fed what it needs. We're just not really there yet.
Do you think it's a matter of how long, Stephanie, they hold rates high, or do you think that it's getting to a much higher terminal rate than people previously expected?
I think it's keeping rates at a restrictive level. I don't think they need to hike that much more, but potentially just one more time. But keeping rates at a restrictive level, we're starting to see signs that restrictive rates are having an impact. And they just need to stay there for a little bit more time. So while housing is bouncing a little bit, still at weak levels, manufacturing activity has really gotten hit pretty hard recently. And then it's really just a matter of the labor market starting to cool as a result of companies realizing that nominal growth for their companies have slowed down below where interest rates are.
John, do you think that people underestimated just how much resilience was baked into the economy and how long some of these loans were? I'm thinking of mortgages for 30 years, that no one is really paying 7 or 8% on their mortgage, or very few. Is that the reason why there is going to be a resiliency for much longer than people previously expected?
Yeah, I would agree with a lot of what Stephanie just said, right? It's the strength of the consumer, the health of the balance sheets, obviously coming out of hopefully a once-in-a-100-year pandemic, which resulted in massive amounts of fiscal stimulus, most of which went directly to consumers' balance sheets, and consumers weren't spending during that time. Now they're coming out, they're spending more, interest rates have moved higher, and there is this lagged effect. You know, some people say it's 6 months, some 12, some 18 months, but I do think you've seen sort of these weird knock-on effects that no one sort of expected coming out of a higher interest rate environment. Home builders, for example, doing extraordinarily well because existing homeowners don't want to sell because they've got a 3 or 3.5 or a 4% 30-year mortgage. That they're just not gonna want to trade, you know, I don't know how to say it, up to a 5 or 6 or 7% mortgage for a new house. They'll stay in their homes for longer. So that takes supply out of the market. And so there's all these knock-on effects that I just don't think people fully understood or fully appreciated, that I think to some degree have allowed the economy to be stronger than expected. Obviously the labor market as well, which Stephanie already covered.
Michelle Bowman was talking over the weekend about stress tests and the need for greater supervision, not necessarily more capital held by the biggest banks. From your vantage point, John, do you think this has been the main sort of holdback for the Fed for why they're not taking rates even higher right now? They want to get a better handle on the financial system and where some of the vulnerabilities might be.
Perhaps. I think it's potentially a little bit of that, but I think it's also, and look, that mattered a lot more 3 months ago when you had the potential for a sort of cascading effect amongst the banking system, which we haven't seen, thank God, because of some of the measures that the Fed put in place. But I think it's also just the lagged effect of hiking 500 basis points in, you know, a little over a year and seeing what the impact is on markets. And again, going back to agreeing with Stephanie here, you know, it doesn't really matter whether they hike another 25 bips, 50 bips, or 75 bips. I think what really matters is how long are they going to stick with rates at these levels and see what the impact on the economy is. I think that's the primary driver of the Fed sort of pausing here.
Stephanie, as we head toward those stress tests on Wednesday, is the banking crisis over?
I think the crisis is over, but the slow burn on the economy is probably not. So really what this means is just banks are going to pull back on lending. We've already seen that. And it's just going to be a continued tightening of conditions in the economy this year. Bank loan growth has slowed down to about 3% on an annualized basis versus 7 or 8 or 9% last year. So it's going to be a slow burn weakness heading in the economy this year rather than a crisis. That part is probably over.
Which types of the economy, Stephanie, do you think will be most affected by the withdrawal of liquidity or the withdrawal of credit from some of the bigger banks?
So the bigger banks are a little bit less exposed to the commercial real estate side. That's on the small banks. So you'll probably see it in C&I loans and certainly consumer loans. That banks will probably start pulling back and tightening standards there, and that's what will get us that needed slowdown in the consumer.
John, do you think that that's going to pressure credit at all, or do you think that that'll bolster certain areas of it where the public and the private credit markets take up some of the slack from the financial institutions?
I think the private credit markets are going to have a hard time doing that. In a zero interest rate environment, capital was pouring into those strategies, giving a a lot of weight to the impact they would have on the lending markets. I think that that trade is dwindling. It's diminishing a little bit. And so I think, coupled with higher interest rates, and obviously you're seeing delinquencies rise as well. We've seen that so far this year. Obviously, the problems in the commercial real estate market have been well covered. Banks will pull back. Private lenders will also pull back. And that will lead to, a slowdown in consumer spending and a slowdown to economic activity.
Stephanie Roth, John Mackay, both of you, thank you so much. Meanwhile, earnings from Carnival just crossing the terminal. Bloomberg's Abigail Doolittle has the latest. Abigail.
Well, Lisa, it's really interesting because this stock in the pre-market had been up more than 2%. Now it is down nearly 4%. So on an intraday pre-market basis, a 6% move, a big reversal, having to do, I believe, with a miss relative to the current quarter guide on adjusted EBITDA. They're looking for $2.05 billion to $2.15 billion, the estimate of 2.09. So it's the low end is missing that. Relative to the quarter they reported, they beat sales. The loss was narrower than expected. They're seeing very strong demand in the second quarter with total bookings reaching records for all sailings. So some mixed messages. I think that the backdrop, though, Lisa, that we need to understand, up nearly 100% on the year, expecting perfection, not quite there.
Abigail, thank you. Coming up, the morning calls, and later, closing out the first half of 2023. We're looking back and looking ahead with Troy Gajewski of FS Investments. That conversation's still ahead. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Goldman Sachs downgrading Tesla to neutral, highlighting the challenging pricing environment. Next up, UBS downgrading Alphabet to neutral, expecting limited upside due to monetization risks with AI. And finally, BMO upgrading Sherwin-Williams to outperform, seeing encouraging trends from the housing market. Coming up, Troy Gajewski joining us of FS Investments. This is Bloomberg.
of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, and the stasis that we saw earlier in the day has turned into a bit of softness, a bit of red across the board as people reassess the risk of what happened in Russia. About 0.1%, almost 0.2% decline at the S&P and the Russell. We're still seeing a bit of a bid into bonds. We are seeing people look at this to a haven, but less so than before. 10-year yields at 3.71%. A bit of euro strength, ironically, after especially a lot of people concerned about what potential risks there could be. It has settled out with a bit of dollar weakness and euro strength, and crude still lower by about 0.4%. One stock to watch at the open, Carnival Cruise Lines, the company out with earnings just moments ago, facing high expectations for the stock nearly doubling this year alone. Melius Research weighing in ahead of the results, writing, quote, following the recent move in shares, Carnival has a lot to live up to, and that seems to be the response. Bloomberg's Abigail Doolittle joining us now with more. Abigail.
Yeah, price to perfection, and investors not thinking that the results and the outlook are perfection. The stock right now down more than 8%. Its worst day since November of last year. Now, of course, ahead of this report, it had been up almost 100% on the year. So again, that idea, not quite what investors were expecting. But it's interesting because it doesn't seem so flawed from a surface view, Lisa. They put up a narrower loss than expected. They beat revenues. They put up $4.91 billion, almost 3% better. They're talking about an acceleration of demand in the second quarter, total bookings reaching records of all sailings. The one big flaw that I can see is the EBITDA, the adjusted EBITDA guidance for the current quarter. The low end is a little bit below the estimate, so perhaps investors seeing some weakness there. The conference call starts at 10 a.m., so perhaps there will be more color that will come out that some investors are already seeing. But again, this stock down 8%, its worst day of the year. Investors not getting what they were expecting, and some of the other cruise operators also down in sympathy.
Abigail Doolittle, thank you so much. Turning now to the financials. Goldman Sachs is said to be cutting a number of managing directors across the globe as it confronts a slowdown in deal making. The latest moves coinciding with recent reductions at JP Morgan and Citigroup as well. Joining us now, I'm so pleased to say, is Bloomberg's Sonali Basak. Sonali.
We're looking at about 125 managing directors, Lisa, being cut over at Goldman Sachs. These are more senior positions, including in investment banking after a prolonged deal slump. Now, we know that deals are starting to come back. It certainly is a merger Monday as we see it today. But again, remember how much these banks have hired. This year is almost halfway through, and you're not seeing a jump back enough to justify so many of the jobs that have been brought on in recent years. Over at JP Morgan, that cut number is about 40 people across different levels of seniority. You have another 20 bankers over in Asia also facing job cuts. And then you have Citigroup looking at dozens as well, both in investment banking over in the United States, as well as corporate banking over in London. So you are seeing banks starting to nip at the heels of their workforce in multiple layers of job cuts. Now, I would also say there's a lot of uncertainty about how this year continues to unravel. We are seeing some of the very top ranks also move around a lot and jump to rivals as well. So not all is bad news, but it is a tense time on Wall Street, and we are seeing people look for new jobs at the same time, both in trading and in investment banking.
Sonali Basak, thank you so much. And turning now to big tech, the NASDAQ 100 looking to rebound from its biggest weekly decline since March, and getting no help from Wall Street with both Tesla and Alphabet on the receiving end of analyst downgrades this morning. Joining us now, Bloomberg's Ed Ludlow from San Francisco. Ed, some downgrades from the likes of Alphabet and Tesla.
Yeah, good morning, Lisa. Let's start with Alphabet, the parent company of Google. UBS downgrading to neutral from buy. In the near term, monetization risks. In the medium term, they're talking about revenue risk from new generative AI-powered search results displacing ad inventory. Among the mega cap names that UBS likes, they prefer Amazon and Meta, both of which have a buy rating with better risk-reward profiles than Alphabet. Tesla also a really interesting one. Goldman, the latest name to downgrade the stock to neutral from buy. Two factors. One, the surge in the stock that we've seen, and you and I have been discussing for what seems like weeks and months now. But two, they also note the declining average price of new vehicles from Tesla. It's the fourth downgrade that I can see, at least in the last week. Morgan Stanley, Barclays, and DZ have all downgraded their calls on Tesla. But remember, this is a stock that's up more than 100% year to date. Kind of zooming out just really quick in the NASDAQ 100, like the rest of the market, we're coming off the biggest weekly decline since March, that week where we had the banking crisis unfold. We saw this move into bonds, Thursday, Friday. I kind of think there's still a little bit of central bank rates, inflation, and what it means for some of the valuations on the NASDAQ 100 in terms of single names going forward.
Ed Ludlow, thank you so much. Sticking with tech, Perma-Bull Dan Ives of Wedbush expecting the sector to continue its outperformance, writing, quote, heading into the second half of 2023, we see a much broader tech rally ahead as investors fully digest the ramifications of this $800 billion AI spending wave on the horizon and what this means for the software, chip, hardware, and tech ecosystem over the next year. Joining us now, Troy Gajewski of FS Investments. Troy, so great to see you. It has been too long. Do you agree that this does seem to be an area that, even though it has been highly valued so far this year, has a lot more room to go?
Well, I think over the next 5-7 years, for sure. The issue in the shorter term, though, Lisa, as we've discussed, is that we're entering a period of market history where you're having the greatest liquidity suck of all time, in that the Fed is back to doing aggressive QT and draining the balance sheet. Remember, at close to 5 times what they did in the last QT, while banking lending has completely stagnated now. When the Treasury is replenishing their checkbook and issuing T-bills, notes, and bonds at a very furious rate. So, back to the points you guys made on Carnival, there are a lot of expectations baked into that share price appreciation, just like there have been in tech. And AI is certainly for real. It will drive revenue. It already has, obviously, in NVIDIA. But is it enough to overcome very elevated multiples at a time where recession risk is the highest it's been since the dark days of the pandemic, when you're having this tremendous exodus of liquidity from broader markets? So in our estimation, the risk reward of being long equities at these valuations is not attractive at all.
It pains me a little bit to put Carnival and NVIDIA in the same sentence in some sort of comparison.
It does, right?
It just doesn't feel quite right, but I'm wondering if that is the parable here, that basically the idea that Carnival had been bid up and priced to perfection to such a degree that even beating results, even beating analyst expectations wasn't enough to stem some pretty significant declines. Do you think that's a playbook for what we're going to get from Alphabet and Google, Alphabet and Amazon, and potentially even Tesla?
Well, I think it's more, we're sort of reverted back to this late 21 period where markets were moved from pricing tech at forward cash flows, because they are cash flow monsters, to back to price to sales again. And we thought that we'd extinguish that last year with obviously the dramatic revaluations. But anytime you're buying an equity or any security on price to sales that are extremely elevated, it's just very difficult to get the organic growth that you need to justify that. Again, particularly at a time where recession risk is set arguably 70 to 80%, and you're having such a drain of liquidity. So, the strongest rallies are always in bear markets. We still believe this is a very powerful bear market rally, and it will ultimately make lower lows. But again, the good news, Lisa, is we're not going to have a repeat of 2008. We're certainly not going to have a bear market as bad as 2002. It's just we've priced all the good news in, and it's really hard to get overly optimistic about expected returns being long beta right here.
How long have you been pessimistic, Troy? Because one thing, Anil Dutta came out with a scathing note to all of the bears out there, basically saying, all right, if you're wrong for 6 months, you're just wrong. And I know that probably stings for a lot of people, including Mike Wilson, who we've been quoting all morning. But do you feel like that is the sign of a peak in terms of valuations, that people are all capitulating at this moment? Or do you think that that is something to pay attention to, that the bears have gotten it wrong?
Well, yeah, so capitulation cuts both ways. It's a great point. I mean, we've really been bearish since the end of 21, when it was very clear that, the Fed would have to hike aggressively. We didn't know how big QT would be, but we knew it would be a meaningful impact. And again, within bear markets, you do have very powerful rallies. Just go back to 2001 as an example, when the Fed had already started to cut, right? And then you had these monstrous bear market rallies. So capitulation cuts both ways. It reminds me of late last year, say September, October, when some of the few remaining perma bulls were starting to throw in the towel. And now you're starting to see people that we think are rationally, cyclically bearish start to throw in the towel as well. Again, if the S&P was at 14 or 15 times forward earnings and recession risk was 10, 20%, we could have a different discussion. But S&P's back up to 19 plus forward earnings. Recession risk is much higher. And again, this is the first time in this bear market, which started in the beginning of 22, where you've had the Fed doing aggressive QT while bank lending has stagnated, while the Treasury is simultaneously pulling out $500 to $600 billion from markets in a very short period of time. So that just doesn't bode well from a risk-reward standpoint. But the great news here, Lisa, is there's still attractive things to do. It's the best time we've seen to be a private lender really since the global financial crisis. You need dry powder to take advantage of that, but whether it's senior secured commercial real estate lending, now you have middle market corporate lending where you're having 5 to 6% higher yields than as recently as 16, 18 months ago. There's things to do. You just don't want to be greedy. This is not a time for greed. This is a time for rational Northwest Quadrant efficient frontier investment strategies.
So, okay, just putting aside the people who are agreeing with you or saying, you know what, we're still bullish, how come someone couldn't listen to this and just say, well, this is, talking the book a little bit, in the sense that let's go into some of these other instruments that aren't traded as frequently, so aren't going to reflect some declines, but at the same time, this has been an area where people view increasingly as diversification, versus aren't they also going to sell off if we do see some sort of material sell-off in the equity sector?
Yeah, so it's a good point, Elise, and that gets back to beta or sensitivity to broader equity markets. And remember, it's not just beta to equities, it's also beta to real estate. And so you really have to be focused on areas that are economically resilient to that downturn. Again, that's why you want to be in the senior part of the capital structure, so you have far less downside risk, while at the same time, because the Fed has already hiked so aggressively, you're earning much higher yields than any of us dreamed of 18 months ago. So if you can make high single digits to even low teens with far less downside, again, if the S&P was at 12 or 11 times forward earnings like it was, prior to QE3 and during the Eurozone crisis, you could argue both areas have attractive upside. But we're at elevated valuations for equities. High yield bond spreads are still relatively tight. And there are areas in markets now, a lot of it driven and exacerbated by the pullback in bank lending, where you can get equity-like returns with far less downside risk. And we just think that's a more intelligent way to position yourself at this stage of a cycle.
And it's probably something that Morgan Stanley's analysts would agree with. Morgan Stanley's Mike Wilson, we were talking about him earlier. He warned of a wall of worry facing off with equities, writing, quote, the headwinds significantly outweigh the tailwinds, and we believe risks for a major correction have rarely been higher. We believe the next leg will be about deteriorating pricing and top-line disappointment. Troy, I know that you have been agreeing with that. So let's put some numbers around this. What type of correction could we be looking for? Where is it led by? And, how long could it potentially be?
Yeah, so look, to us, we've always thought of this bear market as much more mild than 2008 or the financial crisis or 2002, something in the order of 25 to 35% peak to trough as opposed to 50% or greater. You know, we think a rational downside target, again, it's not going to stay there for months and quarters and years, but it's somewhere around 32 to 3,400 for the S&P, where, you know, earnings drop to 200, you get a 16 to 17 multiple on that, which again is higher than the October multiple of last year. And that implies about, you know, 15 to 25% more downside from here. So certainly very, very painful. And the other part that's important here, Lisa, that I don't think is talked about enough is, you know, if you could sit here today and say, hey, I have 5% upside in the S&P, I got 15 to 25% downside. But guess what? Coming out of it, I'm going to make 80 to 100% the next 3 to 4 years because the Fed's going to cut rates to zero and they're going to do another QE. Well, hey, maybe you could tolerate that short-term pain. But the next bull market is going to look a lot like 02 to 07, which was driven exclusively by earnings growth and not by zero interest rate policy, not by multiple rounds of QE. Because we're not going to see another QE unless we have an economic or a market disaster, which at that point, you're going to be begging for the Fed to come in and bail everything out. So again, focus on Northwest Quadrant strategies, accept a modest return. High single digits to low teens, some would say, is better than modest, and make sure you have as little downside as possible, not if, but when the next recession begins late this year or early next year.
Troy, how have you explained some of your conservative positioning at a time when a lot of people are getting greedy?
Yeah, well, look, markets move in cycles and waves, and you know, I think you have to have a consistent viewpoint on asset allocation, right? And what we're talking about here, big picture, is, you know, most investors for 12, 13 years got very comfortable with equities appreciated north of 12, 15, 18%, and fixed income at least not getting devastated. Obviously, 2022 is the complete reverse of that. And now we've seen a short-term comeback in 60-40. But if you think the big picture here, Lisa, the big picture is the drivers of the dominance of equity returns, coupled with a period where bonds outperformed expectations. One was limitless money supply growth. That's obviously a headwind as far as the eye can see. The other was interest rates going lower and lower and lower, which justified higher prices for every asset. And then the third, of course, was the wonderful Chinese labor market, which helped boost corporate margins from 5.5% to over 13%. Yeah. All of those factors are no longer tailwinds. In fact, 2 of the 3 are headwinds. And rates are obviously not going to be the headwind they were last year, but they're not going to be the tailwind they were from 1982 to 2021, right? So, you know, again, back to valuations. If you had a more rational valuation right now, I think you can make more bullish arguments that, hey, maybe the S&P can go from 15 to 19 times. Guess what? We already had that move. We went from 15.75 to 19 and change in a very short period of time, driven by arguably the narrowest market rally in history. That just doesn't bode well for future gains, and it means you have to be much more realistic with your expectations.
Troy Gayeski, you're sticking with us. Coming up, oil prices in focus after political instability in Russia.
Some worries perhaps about supply, about this, but this is a massive chess game, geopolitical chess game. I don't really think anyone really knows what the next move is going to be.
That conversation coming up next. From New York, this is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. From the world of politics.
We're not going to be relying
upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We just have to admit that we don't know how Ukraine's going to work out and how that's going to affect the world. I mean, consider the possible ramifications of what could have happened this weekend, right? A political disarray in the Soviet Union, taking the third largest producer of crude oil in the world off the market, taking a large dominant producer in major commodities off the market. These are events that, just on the economic side, could shake up the world economy substantially.
Commodity markets, meanwhile, breathing a sigh of relief after the Wagner Group called off a short-lived armed rebellion in Russia. The militia reportedly taking control of one of the southern cities where several oil and gas pipelines intersected. Here to take us through the ramifications is Bloomberg's Julia Fonseres. Julia, what's the latest?
It's very clear that markets, if this were a normal market, would have rallied $1 to $3. But because sentiment, macroeconomic sentiment, is so low right now, markets aren't looking at geopolitics at the moment. They don't see supply being disrupted, and so they're going to wait for that to happen until something happens. It's very interesting seeing oil up 30 cents and not really caring as much about this move, even though we did have a pop earlier in the markets. But it's very interesting to see that macroeconomic sentiment keeps dampening all of the supply fundamental and geopolitic drama.
Julia, thank you so much, and truly an important update. You'll be updating us throughout the day. Back with us is Troy Gayeski of FS Investments. Troy, how much are you looking at commodities as a hedge against geopolitical risk versus something that could potentially continue to sell off if, say, the opposite happens and Ukraine gains headway and we end up unleashing some of the bottlenecks?
Yeah, I think the confusion level in commodities has really never been higher. On the one hand, you have obviously China's recovery is not going well at all. The U.S. consumer, isn't necessarily running on fumes because the labor market's still relatively strong, but, the clock is ticking on the strength of consumption. And then you have all the geopolitical cross currents right now. So, again, one of the things that's nice about focus on, say, liquid multi-strategy funds or strategies that don't have that downside risk in a geopolitical storm is you can find other ways to eke out fairly consistent returns. You look at yield curve steepeners, they look attractive again. You look at the secular slowdown and refi activity driven by higher interest rates. There are ways that you can monetize much smaller inefficiencies in markets without having the gap risk to some disastrous outcome in Russia or a far darker outcome in China, right? I mean, you think about how fast that bullish argument's unwound So yeah, from our perspective, commodities have strength. They have higher floors for sure, but it's a very dangerous game to play right now if you're going long oil based on the expectation of some type of geopolitical event.
Just quickly here, Troy, do you think that the commodity space, and oil in particular, has lost its position as a telltale sign on global growth, as a macro hedge against some clear global trend?
Yeah, it's much less clear now than it's been, you think back over 10, 20, 30 years, right? Because, and this has been one of our arguments why it's hard to understand why you could have a true super cycle in oil in particular, just given the electrification of the world. We've always thought copper made a lot more sense as a large, deep liquid commodity, because there you're going to have really relentless demand. Whereas on the oil side, you're going to continue to have demand destruction, or at least far less growth than you've had in prior cyclical upturns. And then geopolitically, it's very difficult to ascertain, which outcome would dramatically benefit you that isn't disastrous to other parts of your portfolio.
Troy Gajewski, thank you so much for your time, as always. Right now, let's take a look at some of the sector price action this morning. Let's get to Bloomberg's Abigail Doolittle.
Well, Lisa, when we go into the Bloomberg terminal and take a look at the IMAP, given the fact that we have this ever so slightly small gain right now for the S&P 500, we have more gainers than not for the S&P 500, but it's somewhat muted. The biggest gain being energy. Well, actually, that's not so muted. Up 1.5%. Materials up 0.8%. Real estate industrials also up 0.7%. So I misspoke. There's actually some pretty solid gains to those sectors. On the downside, healthcare down about 1%. Consumer staples down about 0.6%. Net, though, overall, it's interesting, Lisa, the gain for the S&P 500 somewhat small, up about 0.3%. And it's going to be interesting to see whether or not last week, being the worst week for the S&P 500 since March, if we just shrug that off, or if there's going to be some kind of follow-through on that selling action.
Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our trading diary, because we do see a bit of strength as the session grows older. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Now for the trading diary, what you need to be watching this week. President Biden discussing U.S. internet infrastructure at 11:45 a.m. Eastern. New home sales and U.S. consumer confidence coming on Tuesday. The Fed unveiling the results of its stress tests on Wednesday. Plus, we'll hear from central bankers at the ECB forum. And finally, U.S. GDP and jobless claims coming on Thursday. This was Countdown to the Open. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. What a weekend in terms of geopolitics. What is going on in Russia and Ukraine? We know a lot less than what we don't know. So here's how we're going to frame it out. Leonid Brzezinski, columnist with Bloomberg Opinion, is going to roundtable this discussion with Maria Tadeo. She's a European columnist, correspondent for Bloomberg News. We're going to get those two very smart voices together at the same time via Zoom, and we're going to figure out what we do know at these times. That's going to be how we're going to start this thing off. Markets right now, S&P 500 up 1%. So market's kind of taking this thing in stride, which is good news. Let's kick things off here with a Bloomberg Business Flash. We'll head down to Washington, D.C. for Nathan Hager.
Yeah, we'll be looking forward to getting those insights from our guests this morning because, as you say, Paul, it does look as though markets are sort of looking past the weekend geopolitical risk. Lori Calvasina, the head of U.S. Equity Strategy at RBC Capital Markets, says the markets may be looking for another catalyst out of the Russian turmoil, but as you say, there is a lot we still don't know about the situation.
Well, if markets do sort of march through this in the short term, we could get to, sort of a more dire signal, I guess is the way to put it, in those sentiment indicators at a time that we're getting more clarity. I think it's very, very hard to make any big investable conclusions from this right now, but at the margin, I would say this feels like something that should contribute to nervousness at a time when stocks are seasonally under pressure anyway, something investors are very well aware of.
And at the moment, stocks are moving higher following the worst week for the S&P 500 since March. We checked the markets all day long at Bloomberg, and right now the S&P is higher by 11 points, about 0.3%. 43.59 is the S&P level. The Dow Jones Industrial Average is higher by 21 points. That's little change to the upside, 33,750. The NASDAQ is higher by 75 points, a gain of nearly 0.6%, 13,566. 9 of the 11 major industries on the S&P 500 are in the green, led highest by energy right now. Healthcare is the biggest laggard, down 1.4%. One of the biggest drags in the healthcare space right now is Pfizer. Those shares are down more than 5%. The drug maker is halting development of one weight loss drug after phase 1 trials showed elevated levels of a liver enzyme. And on the health M&A front, United Health is buying home health provider Amedisys for $101 per share, outbidding an earlier suitor, Option Care Health. United Health is down by 0.4%. And Amedisys is lower by 0.2% right now. 10-year Treasury is up 3/32 for a yield of 3.72%. The 2-year yield 4.74. NYMEX crude is up about 0.3% at $69.41 a barrel. COMEX gold is higher by 0.2% at $19.3370 an ounce. The euro trades at 1.0911 against the dollar. British pound 1.2712. The yen is at 143.50. Bitcoin's higher by about 0.5%, trading around 30,500. That's the Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Madison Mills.
All right, Nathan Hager, thank you so much. We appreciate that. Paul Sweeney and Madison Mills in studio. Madison, good morning. Thanks for joining us.
Anytime.
All
Excited
right.
to be here.
Good stuff out there. All right, folks, everybody, this radio program is now being simulcast on YouTube. So if you want to check out the video stream, you can go over to YouTube and search Bloomberg Global News, and that'll get you there for the streaming. Some good stuff there. I'm kind of pleasantly surprised that these markets are showing a little bit of green here. I didn't know what the markets were going to do this morning coming in after what we saw in Russia, but let's bring in a couple people who do know the markets. Bloomberg's markets correspondent Abigail Doolittle and markets reporter Bailey Lipschultz. Abigail, let's start with you. What were your expectations coming in today's trading, and what are we seeing here?
Having nothing to do with the situation in Russia, I did think that we would see a little bit of weakness just coming out of last week. But the reason I think markets are looking past Russia, first of all, there's so much uncertainty around it, which usually could be a reason for markets to sell off. But I think it's an uncertainty of a different type. And at this time, investors, traders would assess that it's unlikely to affect the U.S. corporate profit outlook. At the end of the day, some of these headline risk events, that's the question I was taught to always ask myself. Is this going to affect the corporate profit outlook? Right now, unlikely. Could it accelerate to the point that it would? At that point, you would see investors take a harder stance. Bonds up just a little bit, kind of mixed. Gold is up just a little bit. So overall, markets are telling us that they're not too concerned about this situation in Russia at this time.
All right. Well, Bailey, what are you looking at? And I hope the answer involves Carnival.
Yeah, it does involve Carnival. Since we talked about it on Friday, Carnival right now, worst performer in the S&P 500, down just over 6.5%. The funny thing is, the results were good.
That's
they
what
just
I was saying.
Did not hit the bar that you would set for yourself if your stock is basically doubled this year. So you're seeing some weakness in that. So you're seeing weakness across cruise operators, but really just a solid quarterly results, strong outlook ahead, but maybe not as bullish as analysts or investors may have hoped. The second worst performer in Madison, Pfizer, down more than 5%. They pulled the plug on one of their 2 weight loss drugs on a safety concern. So it does seem like in that race alongside Eli Lilly and Novo Nordisk, Pfizer slipping a bit behind as these drug giants really push to find oral medicines as opposed to those injections that we've seen anywhere, especially
and
if you
I
want
would point out there is a Bloomberg Intelligence has got a huge report out on just the obesity market. Mikey Shaw, author of that, Sam Fazeli contributing, and that's the conclusion they came up with even before this news came out. They said, look at Novo, look at the, what's the other name? But not Pfizer.
Eli Lilly.
Eli Lilly. Those are the ones they were calling out, and it looks like they were right. But boy, the market for that is big and going to get even bigger.
Well, that's the thing is the expectations are that it could be more than $100 billion in size, and these are medicines that you can't stop taking.
Right.
So if you take it, whether it's the injection or oral medicine, it's not something that gets cured or treated. You're on this for life.
Wow, and no surprise, the big growth part is in the United States.
Exactly.
Yeah, good luck. Abigail, what's this market trading on? Are we waiting for earnings, or Are we still on Fed watch, or kind of where are we?
I think it's trading on fumes, actually. The volume is well below the average. The S&P 500 is up, but just a little bit. We have greater strength for the stocks, the banks. PacWest actually had that report that they sold, I think, $3.5 billion worth of assets to Ares Management. So that gives them a little bit of liquidity, as investors are still a little bit concerned about their deposit flow. But I think on fumes, and I continue to believe that earnings season is actually going to almost be bigger than the Fed. Now that is I would say is almost never the case. The Fed's always going to be the biggest, but for some reason I feel like this earnings season is going to be bigger than anticipated.
All right. Thanks so much, guys. Appreciate it. Abigail Doolittle-Bailey, Lipschultz, Bloomberg News, giving us the breakdown on this early market trading here today on this Monday morning. A little bit of life here in the market. Ukraine, Russia. Boy, we did not see this coming over the weekend, or at least I didn't. We need to figure out what's happening over there. And so we asked to get two of our smarter voices over in that part of the world. Maria Tadeo, European correspondent for Bloomberg News, and Leonid Brzezinski, columnist with Bloomberg Opinion. Maria, thanks so much for taking the time. I know you're extremely busy today. I tell you, it feels like the world knows almost nothing about what did happen over the weekend, what is happening. What's the latest reporting about what's going on in Russia?
Yes, and it's very difficult to tell because, well, the Kremlin on the one hand has gone radio silent since Saturday morning. That's the last time we saw from Vladimir Putin talk about this situation. It was interesting that at the time, the language that he used, he basically said Prigozhin was carrying out what is treason. At one point, he didn't mention him by name, but he did say it echoed 1917, which obviously is a crucial date for Russian history. Today, we have seen the Kremlin, to some extent, trying to take back some of the narrative. We did see Vladimir Putin, but almost in a